get started. Okay, you had a chance to kind of look at it. I mean, I understand you probably can't, work through it quite that quickly. That's okay. Just going to want to give you a chance to at least kind of absorb it for a couple of minutes while we're waiting on some folks to walk in. All right. So what this is going to do is just kind of work through some basics of just kind of some of the kinds of calculations, kind of some of the concepts that we're going to be dealing with, and we're kind of expanding on. So this one, obviously, pretty straightforward in terms of trying to understand this first little piece of how much can you actually borrow, okay? And so what you're told is that you've inherited $300,000 in cash, and you want to put that into some sort of an income-producing commercial real estate investment, all right? And you go to a lender, and the lender tells you they're willing to lend you up to 80% on any sort of property that you want to buy. In other words, the loan-to-value ratio. They're willing to lend you 80% of debt on an income-producing property. So that means that your equity investment would represent 20% of the valuation. Well, what is the equity in this situation? That's the money that you have to be able to contribute into the deal, yes? So in this case, your contribution to the deal is going to be $300,000, all right? So let's just start off with that. We've got a $300,000 equity. And what we're told is that can represent 20% of the overall sort of loan to value, or not loan to value, but our equity in the deal. Okay, so in this case, if that represents 20% of the total, then all we're going to do is take the 300,000 divided by 20%, what do we end up with?
1.5.
1.5 million, okay? So the 1.5 million represents what? Does that represent?
His purchasing power.
The purchasing power, okay? The dollar amount that we could go searching for a property within that sort of price point, around 1.5 million. Okay, does that make sense to everybody? All right? Now, what we're also being told is that the lender will give us up to 80% of that overall, basically, value, or the loan to value. And so when we do that calculation, what do we end up with?
1.2.
1.2 million. So that's going to represent what?
His debt obligation.
The debt, okay? Or the mortgage. Okay? So the answer to that first little question is the 1.2 million. Okay? Pretty straightforward. Everybody understand that? Okay? Anybody not understand it? Okay. Let's then move forward. Okay? So the second little piece is kind of the fundamental components of an income statement on a commercial property. All right? You're given a lot of assumptions about this property, about the income and the expenses this property is expected to have, and pretty much just kind of fill in these individual sort of key components, okay? So the first one that we've got, this is when, I guess, go through the assumptions here. Okay, we've got a 10-unit apartment complex containing only one-bedroom efficiency units, renting out at $1,000 per month in rent for total annual potential gross income of $12,000 per year per unit, or $120,000 overall. All right? So that means our potential gross income, the maximum income that we could expect to generate off of the rental income, is $120,000. Now, does everybody understand how we got there? Okay? But once again, we've got rental income of $1,000 a unit times 10. So that's 10,000, okay? And then, in essence, multiply that by 12 months. And it's going to give you 120,000, okay? Everybody cool? All right? No issues, no problems. All right? So the next item that we've got is what we refer to as vacancies and collection losses. All right? What's the difference between a vacancy and a collection loss?
Tenant not paying versus him not being there?
Absolutely. Okay? So it's just simply saying that, you know, a vacancy is you have an empty space, a collection loss is you have somebody occupying the space but they're not paying the rent, okay? All right, so in this case, we're told that our vacancy and collection loss over a typical year is going to be 10% of the PGI, all right? So 10% of PGI is going to be our vacancy and collection loss, so we just simply multiply by 10%. It's going to give us $12,000 as our expected vacancy and collection loss, all right? Everybody still good? Okay, all right. Then, in this case, we're going to add in other income. Now, other income can take on a lot of different forms depending on the kind of property type. You know, for residential properties like multifamily properties, this could be, you know, parking fees, this could be vending machines, could be laundry rooms, could be, you know, on commercial buildings, you could have billboards on the external, you know, side of the building. You know, it could be really any sort of non-rental income is going to be other income, all right? And this can be a huge source of value for the property. So we'll kind of get into that a little bit later, but right now we're just simply taking and saying we've got, on a typical year, it's generating $1,000 in other income from vending machines, laundry machines, etc. So plop that in. All right. And that is going to give us what we are going to call our effective gross income, which, yeah.
For example, would a golf course be additional income, or is it a whole development within?
With something like a golf course, you're going to probably separate out completely, simply because it's going to be its own operational enterprise, separate. And this is also kind of an interesting thing, and we can get really, you know, into the weeds on some of this, like with hotels, because to a certain extent, you know, a hotel is nothing more than a short-term rental, okay, but it's also an operating business because it has all of these other ancillary, you know, forms of income, you know, from their kitchen, from being able to rent out and reserve space for, you know, events, to, you know, whatever other, you know, things that they can, in essence, you know, generate income off of. And so there it gets really messy sometimes in trying to discern what is the actual real estate value versus what is the operating enterprise value. And so the same sort of thing would apply to sort of developments with golf courses and trying to sort of make that division. Now, from an accounting perspective, it can be kind of interesting because you may want to lump them together for accounting purposes because you, in essence, could use some of the management fees associated with the real estate to basically compensate, in other words, use one to, in essence, subsidize the other, okay? And that whole sort of transfer of cost can be really tricky, especially, you know, whenever you've got multiple lines of business. In other words, what is really supporting one versus another versus another. And I mean, even if you own a portfolio of properties, I mean, imagine if you owned 10 different apartment complexes. How do you go about appropriately dividing the management expense across each of those? You can say, okay, I'm going to do it per unit. But what if one really eats up 95% of your time because it's a problem property, you know, versus the others run like clockwork, you know, so should you really just allocate based on unit, or should you allocate based on time? Should you allocate based on something else? And that can be really interesting and really tricky, especially whenever you go to sell the property and being able to accurately sort of portray what the true operational costs are. Does that make sense? Okay. All right. So in this case, solving for our effective gross income, doing the basic math here, it looks like we end up with 109,000. Okay. Now, the simple way that I tend to sort of think about effective gross income, this is the real hard cash money that you've kind of got coming in the door, okay? Because you're not receiving this money off of the vacancy and collection losses, okay? And you are receiving, obviously, this other income along with whatever rental income you're receiving. So this is the net result of the hard money that's sort of coming in the door. Yeah.
For the hotel scenario, how would they report their PGI and vacancy losses?
How would they report it?
Yeah, basically PGI is like as if they rented that specific motel room for every day of the year, minus their vacancy.
Yeah. So in essence, yeah. And in the hotel industry, they're going to use something like an average daily room rate. They're also, going to apply, what the expected occupancy would be over the course of the year. So it's going to be very similar to this, but yeah, you're going to start off with what is the maximum that you think that you would be able to rent out the rooms for if they were fully 100% occupied, at the maximum or the average value that you expect. Because obviously with hotels, it's a bit of a trickier situation because, this week you might rent out a room for $100 a night, but next week it might be $200 a night because of demand. And so it gets a lot more complex in terms of the modeling than, just on a simple little apartment complex. Okay, did I answer the question?
Yeah.
Okay. All right. This is why this is entitled a simple example. Okay, just to get through the mechanics. Okay, so from there, we're going to subtract out our total operating expenses. And in this case, what we're being told is this is going to be 35% of effective gross income. Now, why would it be of effective gross income and maybe not of potential gross income?
Because you didn't collect those.
Because you didn't collect, okay? And this is the money you've actually collected, so in essence, most of your operating expenses are going to be directly proportional to the occupancy. Now, there are some that are not, some that are proportional to the actual size of the complex. Like, for example, you're going to pay probably the same property taxes and the same insurance regardless of whether the property is occupied or not. But in terms of, let's say, maintenance, upkeep, other items that on like a per unit basis of having to do routine maintenance and that sort of thing, that's probably going to be somewhat more directly proportional to the overall occupancy. Okay, does that make sense? Mm-hmm. All right, so in this case, we're saying 35% of the effective gross income. So here, 109,000 times 0.35, so 38,150. All right, and that gives us the number that we're, in essence, searching for here, which is our net operating income of $70,850. Okay, everybody good with that? Yep.
Where did you get the EGI?
I'm sorry?
109.
Where did I get it?
Yeah.
Okay, potential gross income minus vacancy and collection losses plus other income
Oh.
equals effective gross income. Okay? All right. So now we've got our net operating income, which in essence, as I said, is sort of a number that is kind of the key to unlocking what the value of a commercial real estate property is. Because contrary to what you have probably heard many times over about, well, what is it that gives real estate value? And it's all about location, location, location. Well, for commercial properties, while location, obviously may have an impact, the real value is almost 100% determined by what income the property is going to throw off. I mean, you could really care less if the property is located in a horrible area as long as it's throwing off good income relative to what you paid for it. Does that make sense?
Yep.
I mean, some of the best properties that I've owned have been in some of the worst locations because you can acquire them at bargain basement prices and potentially get an above market rent and ultimately get a much higher rate of return than you would maybe in an extremely popular market where everyone is looking at that market, everyone is investing in that market, and the prices are being driven up artificially high relative to what the rents are, and so you end up with a lower rate of return, okay? So, sometimes the common sense that a lot of people apply of saying, oh yeah, it's all about getting that premium property and that premium location is not necessarily true. I mean, some of the richest real estate investors that I have met have invested in some of the crappiest pieces of real estate I have ever seen. I mean, we're talking about mobile home parks, you know, we're talking about self-storage units, we're talking about properties in undervalued, you know, economically depressed, you know, areas. And it's not about being a slumlord, okay? It's about finding value, okay? And so at this point, all we're doing here is coming up with, well, what is that income this property is going to generate, but then how do we translate that into an actual dollar amount that we would be willing to pay for the property? And that's kind of the next step, all right? So this next little piece, assume that we have a standard capitalization rate or cap rate for this property is 5%. What is the implied value of the property? All right, so what I've given you on this little handout are basically the 3 different ways that you kind of go at getting what it is you're searching for. If you look at it, it's the same 3 variables, but they're just juxtaposed to basically allow you to solve for one of the 3. Okay, so if you're given 2 of them, you can solve for the 3rd. Okay, so in this case, what are we given? Well, we are given sort of the annual NOI, all right, and we're given the cap rate. So in this case, we're going to be pretty much solving for the implied value. And so here, that's going to be NOI divided by our cap rate. All right. Well, if our NOI is $70,850, and we've been told our cap rate is 5%, then the implied value of this property
460.
is $1,417,000. Okay. Now, first question that some of you should start asking is, okay, what is the cap rate? Okay, if you read the material from today, one of the things they talk about a little bit is the cap rate. Anybody have an idea how to explain what the cap rate is?
The return if you bought the property all cash.
Okay, that is one way to explain the cap rate. It's basically what your annual rate of return is on the property, assuming that you paid all cash. Okay, that's one definition. What else? Okay, those of you that read the material, one of the things that they talked about was using something called the Gordon growth model. Does anybody remember that? Okay, all right, and what is the Gordon growth model? Those of you who had finance undergrads, that should have been plowed in your head.
Yeah, it's basically when you take your growth rate plus less your cap rate over your NOI.
Okay, actually, it's taking the discount rate minus the growth rate and you're taking your income, in this case net operating income, and this is going to give you
Value
the value, but the cap rate,
is
this piece of it, the discount rate minus the growth rate, okay? Now, whenever you take a look kind of at this initially, the first time, for those of you that did not have kind of any sort of a background in finance at all, okay, and you sort of think about this, it doesn't quite make sense at first glance because you're saying, well, why don't you take the discount rate and then subtract out a growth rate? Well, let's just kind of work through a little example here to kind of show what we mean. All right? So let's just assume that we use the net operating income number that we've got here of the $70,850. All right? And what we're told is that the cap rate is actually 5%, okay? But what we're not told is what the growth rate is and what the discount rate is, okay? Well, let's assume that the growth rate is 2%, okay? And what that means is the income is expected to grow annually at 2% a year. Does everybody understand that? Yes or no? Okay, so if that's the case, what would that make our discount rate? No. No. 7. Because 7% minus 2% is 5%. Okay, does everybody follow? Okay, now let's assume for a moment, all right, that we didn't have any sort of a growth rate, okay, meaning that our income is going to stay flat. Does that make sense, everybody? Okay, so this is where it kind of begins to make sense, because now, without any sort of a growth rate, our cap rate basically becomes what? Our discount rate, or 7%, yes? Okay, so now the question is the value that we're going to get here going to be higher or lower than what we got up here?
Lower.
Lower, okay? Now, that's a little bit, sort of, at first you're like, well, how is that possible? Once again, if you're taking away the growth rate, well, let's explain. Okay, first of all, let's do the math. So 70,850 divided by 0.07 would give us a value for the property of 1,012,142, and then we're going to put the pennies out there, 86 cents. Okay? All right. So that's a pretty substantial difference. I mean, basically about a $300,000 difference, all because of not having any sort of anticipated growth in the income for this property. Okay? Hopefully now this begins to at least conceptually begins to make sense. I mean, I can still see some of those looks in your face, the bewilderment and puzzlement. But here's what we're really saying is, because in essence we are demanding, if you will, using this discount rate of 7%, we're discounting the income that much more, okay, to come up with a value for the property, all right? And the reason we're doing that is because there is no growth attached to that income. In other words, this number from now until whenever, 5 years, 10 years, 15 years, our income is going to stay constant at 70,580. Whereas if we apply the growth rate of 2%, that number is going to constantly grow at 2% a year, basically forever, is the expectation. And so if you have that extra layer of growth, that is going to contribute to an overall increase in the valuation for the property.
Is the growth rate typically 2%, or is this just?
This is whatever. I mean, to a certain extent, you could use a lot of different measures. It could be, something is like, consumer price index. Could be just simply if it's residential property, some sort of a housing related index of okay, here is what the anticipated growth rate of housing would, the cost of housing would expect to be. Commercial property, same sort of thing, and so that growth rate may also not be fixed. But it could change so that from one year it might be 1%, next year it might be 3%, next year it might be 1%, next year, but then you're going to model that differently. Okay, this model simply is the most basic of them all, which simply says we have a fixed growth rate of 2% forever and ever. But now, so what I'm saying is that whenever you get into the more sophisticated, financial modeling that you guys are going to be doing, like in San Miguel's class, then what you're probably going to find is that one year you might have a growth rate in rent of 3%, the next year 3.5%, the next year might be down to 2%, just depending on whatever assumptions that you make. But many of those assumptions may be driven by the lease that is in place on the property. Because in many cases, especially for commercial leases that have longer lease terms that may go well beyond 5, 10, 15, 20 years, they have embedded within those leases an automatic maybe stair step of the lease, or it could be tied to a revaluation of the property at some point in time. That they may say, okay, for the next 5 years, you're going to have fixed rent of a certain dollar amount, But then at the end of that 5 years, we're gonna have an independent appraiser come out, value the property, and then based upon what that new valuation of the property is, we're gonna reset your rental rate to that, effectively that new value. Does that make sense?
Yeah, you answered my question.
Okay,
You answered.
okay.
For the discount rate, is it a fair assumption that the higher the discount rate, the lower the?
Yes, because in essence, you're discounting, the way to sort of look at that is you're saying this income is worth less and less and less the higher the discount rate becomes. You're discounting it more. You're saying it's worth less because you're basically requiring a higher sort of percentage of that income to be devalued, if you will. Does that make sense? Now, all of this is great, but here's another piece to this. This discount rate, this growth rate, and the overall cap rate aren't constant. In other words, over time, they go up and they go down, okay? And sometimes you may have a situation where the discount rate goes up, the growth rate goes down, or vice versa, okay? So what you have to do, obviously, is to kind of understand what the conditions are for this particular property type within this particular market. Because what you may see happening here in Fort Lauderdale may be very different than what you see happening in Miami, which may be very different than what you may be seeing in Austin, Texas, or Nashville, Tennessee, okay? Because each market is uniquely different with respect to who the players are, what the demand is for the product, the availability of the product in terms of the supply of the product, the quality of the product, all of those sorts of things. And to a certain extent, you know, roughly how we tend to get around to these numbers is by looking at what previous properties within that market have sold for to try to give us an indication of what this cap rate might actually be. And it's also going to be influenced by prevailing interest rates in the market. But if interest rates are really high, that's going to have an impact on that, okay? And if interest rates drop, that's also going to have an impact, okay? And a simple, probably the simplest of all kind of economic relationships is if interest rates go down, real estate prices go up, okay? That's probably the simplest, you know, relationship that exists. Just as much as interest rates go up, real estate prices go down. Well, and that's basically brought out by this very model, okay? Does that make sense? Yeah. All right. Questions? Yep.
Touch based on growth rate, how about the discount rate?
So the discount rate could be specific to that particular investor based upon their cost of capital, their source of funding, but it also could be more market-based for that particular product type within that particular geographic region. In other words, to say, I mean, you can get all these reports that will say, okay, the current, you know, cap rate or the current discount rate for this particular property type, this particular market, you know, is this currently, and all that's really being based on are sales that have taken place pretty much within the market within maybe the past 6 months or a year or whatever it might be, with maybe some little adjustments to, you know, if interest rates have made a shift one direction or the other. The point that I guess I'm trying to really make with this is it's not a number that is so rock solid that, you know, you hang your life on it, you know, kind of thing, but it's one that the deeper the understanding that you have of the market can sort of change what the cap rate might be for you as an individual investor. For example, let's just say that I'm an investor in a market that I am intimately familiar with, that I know every player in the market, I know every property in that market, commercial, residential, doesn't matter. I know every transaction that takes place, but yet Chase back there has no knowledge of that market whatsoever. He's from out of town, has never ever made an investment in that market, doesn't know anything about it. My personal cap rate is probably going to be a lot lower because I assess it to be a lot less risky than potentially Chase might, because he's not as familiar with it, therefore certain elements of the risk are going to be higher. Does that make sense? Okay, you have a question? Phil?
It's just like a comment, just because like with the lower cap rate, obviously it makes your, okay, so with the higher discount rate, it makes you can't be as competitive with your pricing, essentially.
Yeah, so if your rate of return or your discount rate is higher, then that means that obviously the value is going to be lower, okay? And so what happens, you kind of put it in context in terms of players within the market, all right? If you're a solo player and chances are you're going to be requiring a higher overall rate of return than some sort of an institutional player, okay? An institutional player is like a pension fund, you know, insurance company, some sort of major, you know, sort of investment fund, retirement fund, whatever it is. Those folks tend to have easy, cheap access to capital and lots of it. And they can afford to take a very, very low rate of return on a lot of the investments that they do. They structure them in such a way that they can try to minimize the risk, but they can usually access capital at maybe several percentage points below what the average ordinary investor might be able to. Therefore, they can afford to spend more on the property than the average ordinary investor.
So they have a lot of value for that growth, because right now, at least what I've been taught, you know, like you want to buy and look at the return you're getting now. And so I'm not even accounting for the growth. I know that's like
No, and that's a conservative way to look at it, but even a more conservative way to look at it is, okay, yeah, you're valuing the income that you're getting now, but you're hopefully being realistic about what that future income is going to be or not going to be. That, you know, and I'm an optimist by nature, but I have to sort of say, given where we are in what I would say is kind of the market cycle, we have kind of crested, and we're at that point of, are we going to go way down, are we going to go slightly down, or are we going to just kind of hover, you know, where we are? I don't see us going like a rocket ship up,
yeah, okay.
you know, and so
That makes sense.
my point with that is that if we're really being honest with ourselves, then, you know, there's a very good chance that you're going to see a decline brought on by a whole number of things, okay? You know, this is why, like, at the federal level, they get so obsessed with, you know, federal funds rates and, you know, interest rates, you know, and what those are doing, because the lower those are, the more buoyant, you know, the market is as a whole. But yet you don't want to have them so low as to, in essence, that you're not getting a reasonable rate of return on those particular types of instruments relative to the risk that you're incurring. Okay, does that make sense? Cole, Chase?
So the discount rate, just like sum it up, like it includes the cost of borrowing money typically for whatever the investor, developer, whomever's doing the deal, but then it also, like that's like a hard factor, something that you can tangibly say, look, I borrowed this money at 6%, but then you want to include like 1% kind of like a risk discount rate for, God forbid, things, you know, hit the fan.
Right.
So it's like a mixture of almost like,
It is.
okay, like real data and like
Yeah, so
implied data.
what you're going to see as we get a little bit deeper into this, and this is why we start off with this really simple example, is we start looking at what is our cost of debt, but then also what is our cost of equity.
Right.
Okay, and then we want to blend those two into basically our overall cost of capital. All right, and so what you're going to more than likely see is you may have a low cost of debt, but then a really high requirement on our equity in terms of making a return on the equity piece. Well, those two get blended together, and then that, for the most part, ends up becoming our own personal sort of cap rate.
Gotcha.
Okay?
Question.
Yep.
On the discount rate. So if the discount rate, you're not carrying any debt, if it's your cash, so you're only using your equity.
That is correct. So if it's an all-cash deal, then that discount rate is just the money that, you know, once again, the rate of return that you would want on an all-cash deal. But as we, once again, begin to complicate things a bit more and start introducing debt into the equation, then it becomes, you know, that much more complex.
So when we, in the book it explained in the last chapter, we were seeing the confused part. So when we see the 1 plus the percentage, this is what that means.
Okay, so let's tackle that real quick.
Can you
All right.
repeat the
So-
question? I didn't hear that.
Okay, So in the book, one of the things that it does, which I don't tend to do, is it shows you all of the actual mathematical formulas to calculate present value, future value, you know, calculating your net present value, that sort of thing. So if you want to see actually the formulas for those, so for example, the formula for present value is equal to the future value over 1 plus the interest rate raised to the number of periods, okay? Whereas future value is equal to present value times 1 plus the interest rate raised to the number of periods, okay? Now, we don't have to do any of this because our calculator does it all, okay? So the point is that if we wanted to calculate, you know, the present value for some sort of a future dollar amount, all we would do is we'd say, okay, the future value is, let's say, $1,000. Our interest rate is, let's say, 5%, and the number of years is 2, okay? And then we would go through, and so this would then become 1,000 over 1.05, which is what you're talking about, 1 plus the interest rate, okay? In this case, raised to the power of 2, all right, which is the number of periods that we're sort of going out into the future to come up with that value. So in this case, just to kind of illustrate, 1.05 raised to the power of 2, all right? So this is going to be, it's kind of 1,000 divided by 1.1025, okay? That's what the 1.05 raised to the power of 2 is. And then we solve for that. And so that means the present value is going to be $907.03, okay? What that means, once again, from the textbook, the way that it sort of explains it is, all right, if we are receiving $1,000 and we're receiving it 2 years from now, how much would that be worth to us today? $907.03. Now, you don't have to do any of this math, okay? Calculator does it all. So like a calculator, just to sort of show you, the calculator, you put in 1 payment per year, kind of clear everything out. We'll put in 1,000, hit the future value key, put in 5% as your interest rate, put in 2 years as your term, simply solve for present value, and you're going to get the same answer, 907.03. Okay? Does that make sense?
Makes sense.
Okay. So it's just a lot easier to use the calculator instead of having to go through all the math. When I learned this stuff 30 years ago, we had to do all the math to come up with the answers, and it took you basically 10 minutes to do every single little problem. So
They gave us tables.
yeah, and then tables, you know, anyway, long, we don't need to go there right now. Okay, moving on. All right, so any other sort of final questions with this piece of it? Okay, yeah.
Is the growth based on like the value of the property or the income? Because like let's say like what you were saying, if there's
Both.
Okay.
Or the market.
Like if the market goes down, but you get a decent deal, like 7, 8,
Yeah,
9%, and then your equity just disappears.
Okay, think of it like this. Let's assume that the market is headed for a downturn. We pretty much, let's just say we sort of know that.
We agree on that, yeah.
Let's say that you're able to lock in a 20-year lease with the state government or federal government for leasing a piece of your property for some sort of government office. But embedded within that lease is just an automatic stair step of 1% or 2% per year sort of growth rate in rent with no reevaluation of that rental rate until the completion of that lease 15, 20 years later. All right? So in that case, you're totally, completely covered with respect to your property. The market can go completely down, you're okay. Because in essence, you've got a locked-in lease that's ironclad with a governmental entity. Does that make sense?
What about like residential multifamily? That's like yours off market, you know?
That's much more difficult because there you got year-to-year leases. So, you know, as the market adjusts, you know, from one year to the next, really almost even 1 month to the next, you know, in terms of what the lease rates are. Because if you own a large portfolio of multifamily product, you're going to be looking every single week, every single month as to who your competitors are, what their occupancy rates are, what their rental rates are, and constantly making adjustments so that you're marking to market whatever the lease rate is for your particular, you know, property. But all of that having been said, hopefully you're taking a more strategic look beyond just the day-to-day kind of routine look at what those rents are doing and saying, okay, do we expect that the value of this property and the value of this location is going to increase substantially over time? That, for example, I mean, this is just me talking off the top of my head, but you take somewhere like Flagler Village, okay, in Fort Lauderdale, okay? I would argue you've got some really nice new properties that have hit the market there, okay? But the big caveat that I would have that keeps them maybe from fulfilling what I would say really their full potential is there's not enough currently base level sort of retail in the sense of restaurants, bars,
Yep.
you know, sort of walkability, you know, of those particular units. They're beautiful, but you're still gonna have to take an Uber or take a scooter or do something to be able to get to where maybe you wanna go.
There's no activity going on.
There's not a lot of activity, you know, and so versus, let's say that you're right smack down in the middle of Los Olas, you know, in one of the high rises there. I mean, my expectation would be, yeah, you're gonna pay more to be there on Los Olas, right in the middle of all that activity, but you can walk out your front door and have access to it, as opposed to, you know, parts of Flagler Village that are a bit more isolated than others. Does that make sense?
Absolutely.
So going back to Flagler Village, I actually am looking at a duplex near there. And for, like, let's say that in 2009-10, you could pick up these duplexes for 30, 40,000 a door. But now the seller is asking 80 to 90 a door, and it makes sense because you can Section 8 it, you get a good return. But then if the market turns, which we both agree that it will, like, how do you measure, okay, do I buy it or do you pass on the opportunity and wait for a new opportunity to eventually close when the market goes down, or, like, you know, how do you rationalize that?
The timing of that is the problem. That's the problem, all of the space. You know, I don't have any crystal ball as to when that specific magical shift is going to occur.
Exactly.
And you know, it's sort of been a while coming. We know it's coming. We can feel it's coming, but then there's also other mitigating circumstances. What happened with federal tax law changes, you know, a couple of years ago? Well, they limited property tax deductions. Well, so what do you have happen? You have this mass exodus of people from those high tax states to where?
Here.
South Florida.
Yeah.
So all of a sudden, you've got this huge influx of people demanding that much more product, driving up the market that much more. You know, in Miami, you know, for years, you've had this weird bifurcated market, part of which was driven by drug money, and part of it, you know, was normal, you know, kind of people. Well, but that drug money fueled a lot of speculative real estate investment, a lot of, you know, high-rise residential product that was way overpriced, and some of it still is way overpriced, but it's being funded by not real money. You know, I mean, in the traditional sense of a real economic kind of employment-based economy.
So you're saying it's tough to perform out drug money?
He's speaking from experience.
It's an interesting thing because, you know, my point in trying to answer your question as directly as I possibly can is there are going to be other parts of the country, and are other parts of the country that clearly are already suffering. You know, the market's going down. Mm-hmm. Ours may be relatively shielded because of being a low tax state, that we may actually be able to sustain that much more growth and that much more sort of viability and stability. you know. But there may be other factors that come to bear that, you know, none of us are really thinking about or thinking are going to have as much of an impact. So I'm not trying to give you a non-answer to your question. I'm just saying it's a complicated, you know, situation of really, you know, all the different factors that influence something as simple as, you know, a condo purchase decision. If you really step back and you really begin to analyze and probably overanalyze it, you may talk yourself out of it. But then again, sometimes it's just pure dumb luck. You know, you buy the thing, you buy it at the right time, woohoo, you know, it's all great, and you're able to sell it at the best possible time. But then there are, you know, just as many other people on the other side of the equation that are selling it at the wrong time and buying it at the wrong time. I mean, I don't know if that helps at all.
It just comes down to, like, do you want to get a decent return now and buy competitively, or do you want to wait and speculate on when the market goes down to get an absolute killer?
Right.
And it's like, how do you decide that? And that's the ultimate question.
It is. And I totally 100% agree with you. And all I'm saying is there are all those other factors that if you really feel comfortable in kind of understanding the interplay of all those things, I mean, it's put this way. There's been a lot of new product that's been brought to the market, all right? And as a result of that new product, are we getting people to fill that new product in a very timely fashion? And if we are, then, you know, for the moment, we're probably okay. But yet, if it starts to, you know, slow down, and then once again supply dramatically is greater than what the needs really are, then we've got a problem. That's where the market obviously then goes down, because you have people chasing after tenants. Right now, they're not really chasing as much as they would be obviously in a down market. Okay. All right.
So just to reflect back on that government contract with the growth rate, that would be like 20 years, 1% in a down market. Isn't it also possible to have, like, say it's like a U.S. Postal Service or just like some kind of administrative building for some kind of governmental entity? Aren't they typically written in the contracts where at any point, if they decide to up and leave, like they can break the lease?
That totally depends on what the contract. I mean, the
heard
GSA,
like
the General Services Administration, is the one that pretty much handles all the real estate operations for the federal government. And they're smart people. I mean, I'm not going to, you know, but what I'm saying is, it depends on how much market dominance that you may have,
right,
you know, how badly they want your spot.
What the negotiations look like.
And, you know, versus, are they just somebody looking for cheap space and they're,
right,
you know.
because that was like my thing, is like if it's 20 years, if the market starts declining, they're locked into a rate and they can find it elsewhere, you might think that you have like a concrete tenant, but 5, 10 years in,
yeah. Now, most of the time with the governmental leases, they're typically part of just the value of having them is that they kind of lock themselves into maybe a lower price point, but then they guarantee.
Right, right.
And there's like a prepayment.
Okay, somebody else over here had a question?
Could you just go over what you did on the type again?
Okay, on which part?
The last, yeah.
Oh, okay. We're gonna get back to that.
Okay.
All right. We haven't really gotten. I mean, that was kind of an aside. And we'll get back to the actual use of the calculator a little bit later. Okay. Anybody else? Question, comment? Yep.
Yeah. You know, in like financial markets, we talk about how you can make money when the market goes up, down, or moves sideways.
Right.
Do you think the same kind of exists in real estate markets?
Yeah, absolutely. Yeah, I mean, you know, I'm the kind of guy where I'm waiting for the next downturn. You know, I can't wait for the next downturn because, you know, that's where I want to come in and buy properties undervalued, below replacement cost, and then, you know, hold on to them for a couple of years as the market recovers. That's the kind of player that I am, okay? You know, versus being the kind of player that's constantly chasing, you know, every possible new deal as it sort of comes along. And part of the reason for my philosophy with that, many, many years ago, this had to be in the mid-90s, I was teaching at UT Austin, and one of the real estate developers that was also teaching in our program there, he, very seasoned guy, been in the business for many, many years, and he was one of the smart ones. He got out of the real estate market in the 1980s at the perfect time, sold everything off, and his philosophy was very simple. He said, I knew the market was about to tank when I was playing golf, and my caddy was talking about how he had invested in real estate and was flipping houses and making all this money, and he said to himself, if the average ordinary person who's unsophisticated is making money in real estate, it's time to get out, okay? Because, you know, the whole thing is about understanding the direction of the market, understanding when it potentially is peaked, and not getting overzealous. There have been plenty of developers that have gone, you know, that were massive developers that have gone bankrupt because of poor market timing, okay? But part of the problem, you say, okay, it's all their fault, but then there's also the aspect of the gestation period of the product they're bringing to market. All right, you want to build a new high-rise residential project? How long does it take from the moment that you have the idea, I want to build a high-rise residential product in downtown Fort Lauderdale, to when it opens up for occupancy?
At least 5 years.
Yeah, at least 3 to 5 years. A lot can happen in 3 to 5 years in terms of market dynamics. I mean, the perfect time to do that is you're basically starting to plan that thing while you're down here in the depths of the market, so that hopefully you acquire your land at a bargain basement price, and then, you know, go through all the planning stages and go through the pre-development stages, and then by that point, maybe the market, especially the value for your land, has started to increase substantially, and then you're able to build your product and you know, everything is wonderful. But what happens is, you know, even the best of developers are out there still chasing deals whenever the market is at the absolute peak. And then, once again, then you've got this gestation period of 3 to 5 years, and by that point, you could be in the absolute depths, okay? So, you know, the whole thing of fortunes made and lost in real estate, there's no truer statement that can be made, you know, with the best of the folks, okay? So, you know, market timing, you know, is absolutely mission critical. Now, hopefully, one of the things that the better players are able to do is kind of like the guy I was just talking about. They're able to sense, okay, we really have crested on the other side. It's time to get out. It's time to get out now. Sell everything I've got and put the cash in the back pocket and move forward. And let somebody else take the fall. Does that make sense? Okay. All right, moving forward. All right, so this question, this number 3, obviously the one that applied, we did the calculation there, the 1.4 million. All right, and then at the bottom, question 4, assume that this property is priced by the seller at 1.3 million. Should you potentially purchase this property? Why or why not? Okay, so if it's priced at 1.3, by the seller, should you buy this property? Yes or no?
Yes.
Okay, Cola's saying no.
There's such a low cap rate for multifamily.
Okay, ignoring that. Just simply based, you're going to make the assumptions of just what you're being given. And in this case, the seller is pricing it at 1.3, but in essence, you're saying, based on your analysis, using the assumptions that you were given, you're saying that it's worth 1.4 million, okay? So under those conditions, yeah, you would want to go ahead and buy it. You've still got, you know, $100,000 or so difference there between your valuation of the property and what it's being priced at, okay? So there's still some, you know, play there, excuse me, to be able to deal with. And the 1.3 is still substantially less than the 1.5 million that you have available to you in terms of your raw purchasing power. Okay, does that make sense? So all this little example is meant to do is to kind of walk you through on a very simplistic basis kind of some of the things that you need to think about as you are trying to make that sort of valuation and then ultimately purchase decision. Okay, is everybody comfortable with that? Yes or no? Okay, any questions on that?
How did you get to the 1.4 million?
I was just taking the NOI divided by the cap rate.
Oh yeah, the original, okay.
Yeah.
Gotcha.
Okay? Okay, let's do this. It's 9 o'clock. Let's take a 5-minute break, come back, and then we're going to jump into some other stuff. Okay? And I do mean 5 minutes. I don't mean 10 minutes. I don't mean 15 minutes. I mean 5 minutes.
5 minutes.
It is precisely 9 o'clock. You have it till 9:05, and I will start at 9:05.
he has a lecture from a guest speaker, he may answer your question on bonding.
Okay.
I don't know, but I know he graduated in 2009, and he spoke about how he evaluated and purchased different properties. Like, he was asking the same question we was, well, he was talking about the same question we were asking.
Yeah, I mean, I like this stuff. This is like what I
Yep.
want
So,
to learn.
on a
The
monthly
last couple
basis,
classes were cool, but like,
do they take,
No,
this is what's practical.
the year and the year,
I agree.
they just go back, purchase the year, or?
In terms of, like, you're saying that you only have 6 months worth of operating
No,
statements?
no, but the year's not completed, so.
Oh, I see what you're saying. Well, you could do one of two. You either use last year's calendar year, you can use last year's fiscal year, or just simply go back the previous 12 months from today. I mean, the previous 12 months from today is obviously going to be the most recent,
Yeah.
and still going to capture any sort of seasonal differences that you're going to see in the property. But the key is that, especially for hotel properties, you're going to get, you know, what is that seasonal variation.
Okay, perfect, thanks.
This is where I'm at, huh? I had a good grade. I know Raymond responded. I didn't hear Connor, but I saw Connor. He's your good with Jazz. With Jazz? Yeah. I studied it. No, but I got a good grade. I got a better grade on the site back.
I looked at all the data, all three and four.
Yeah, it was wrong.
We did.
Double speed, like,
I looked at that, I was like, I'm just gonna
do you know how to use this
on
stuff?
the section.
Like actually? Or you know how to type things through the stuff? How long were they?
The chapters, it was like 33 pages.
Whatever number, I thought it was part of the standard breakdown. I think it was the
It was kind of 31. But like,
whatever was the extra credit.
it threw the percentage out.
Because I know we looked at the thing that only 8 people actually did it. So I think everybody in our group did it.
Okay, it's 9:05. All right, everybody have their financial calculator?
Yep.
Okay, so here's what we're gonna do. The plan is this. We're gonna spend a little bit of time showing you how to use the financial calculator. For those of you that already know how to use it, you can maybe just kind of take a little bit of a breather. Maybe you might pick up on something you hadn't picked up on before. But I'm gonna sort of take this from ground zero, okay? Assuming you know nothing about how to use the financial calculator. And then from there, what we're gonna do is we're gonna jump into a list of sample questions that I've given you. There's like 20 sample questions. We're going to work through some of those, not all of those, because some of those are going to relate to some of the things we're going to be doing next week. Then we're going to go over any sort of loose ends out of the reading that was assigned for today. Then we're going to have our first little quiz, which will be 10 questions, all computations, and just make sure if you didn't read the syllabus, the way this class is structured is we have a total of 8 quizzes, okay? And those 8 quizzes count for 100% of your course grade, okay? Now, if for whatever reason you miss a quiz, you're out sick, you're out of town, you do poorly on the quiz, whatever, the way that it's going to work is you're not going to be able to make up that quiz individually. What you will be able to do is you will be able to take a midterm or a final that will cover, the first 4 quizzes will be covered by the midterm, the second 4 quizzes will be covered on the final, okay? And that will be administered outside of the normal class time. You'll set an appointment with me, you know, and we'll set aside a couple of hours for you to do that. And it will be basically the same sort of questions, probably the numbers change, that sort of thing. But the difference is, with the in-class quizzes, it's open book, open notes, open calculator, closed computer, okay? But for the midterm and the final, it's closed book, closed notes, closed computer, okay? Does that make sense?
Open calculator.
Open calculator. All right? So there's an incentive built into this process, and it's worked pretty well, that basically as long as you pay attention and you're following along, and if you do a little bit of preparation before you come to class, you're going to be that much better off. You take the quiz, and hopefully you do well in the quiz, and you don't have to worry about taking the optional midterm or the optional final. But for whatever reason, you've got to go out of town for a wedding, you've got to, you know, you're not able to be here because you're sick, you know, I'm sorry, but the reality is you're going to take the midterm and the final, and then that will simply replace those 4 quiz grades. Does that make sense, everybody?
Yes, sir.
Okay? All right. So, let's just jump in on the financial calculator. All right, so over on the far screen should be kind of what looks like the HP10B with a few little minor modifications. Now, a couple of you had actually emailed me and said, well, can I just download the app on my phone and use? No. And there's a couple of reasons for that. One is I have no idea what other stuff you may have stored on your phone, nor do I want you taking pictures of quizzes and things like that with your phone, nor, you know, do I, but actually there is another reason not to use that app. That app was not developed by HP, which is the manufacturer of the calculator. And I have run into, especially with the more complex problems, the app doesn't function correctly, okay? And so you will get the wrong answer. That's what I'm trying to say. So get the HP10B. I've got plenty of them here. I'll loan out to you if you don't have one. But you're definitely going to need it in order to work through these problems. If you're using anything other than the HP10B2, you're going to be lost. Okay, it's as simple as that. All right. So you think, oh, I'm a master at using the TI, business analyst or whatever. No, use the HP10B. Trust me. Okay. All right. So we've got it popped up here on the screen, and what we're going to do is kind of walk through a few little basics and I'll try to go through this as quickly or as slowly as we need to, depending on kind of how you are sort of absorbing this. So one of the first things that you kind of got to get familiar with is the shift and clear all. All right? So with the HP10B, this orange button is the shift key. Okay? Now, in this version of the simulator here, it actually puts the word shift up in the display. On your calculator, it doesn't do that, or at least I don't think it does.
Shows in the bottom.
Yeah, but yeah, it doesn't really, it does have a little bitty designation, but not much of anything. But anyway, the point being is, that is simply to access functions that are basically in yellow, okay, or orange, as it may be. All right, so if you hit the shift and then you hit the clear all or clear key, on your calculator, what it will do is it will pop up briefly in the display something like 12p year or 1p year. Does everybody do that? Yes or no?
Yes.
Okay. Now what that is doing is that's telling you what the calculator is currently set for in terms of the number of compounding periods per year for interest rates. All right? So if it says 1p year, that means it's annual compounding, meaning once a year. If it pops up 12p year in the display, that's monthly. Now there are plenty of others that could be used, but in real estate, the only two we almost ever use are monthly or annual, okay, when we're dealing with data. But just, you know, those of you that maybe have had some sort of a finance background, you might, if you did 4, that would be quarterly. You could have 26 times a year, sort of bi-weekly or bi-monthly. Maybe more bi-monthly, really. You could have 52, which would be weekly. You could have 365, which would be daily. But we pretty much don't use any of those in real estate, okay? So just kind of don't really bother worrying about that. But my point is, when you hit that shift clear all, that should be the absolute first step to every single problem that you do. So everybody hear me on that. Because that will dictate whether you're going to get the right answer or not. Because if you have a problem that's in front of you, it may seem like a really simple problem, but it's like you're wanting to calculate a monthly payment, but your calculator is set on annual, it's going to give you the wrong answer, okay, if you're solving for a monthly payment. All right, so that's the very first thing you do, just to identify what it currently is. Now, if you want to change it from what it currently is, you hit 1, shift, and then payments per year, which is on the top row of the calculator. So I'm going to hit 1, hit the shift key, and then up here, you see the PMT, I hit that, and then it changes it to 1 payment per year, or annual payments. Does that make sense? Now if you hit the shift clear all again, what you should see in your display, if you've done what I just said for you to do, it should now say 1p year in the display. Yes? Okay? To put it back to 12, same process. 12p year, and then to check it, hit the shift clear all, and it should now say 12p year in the display. Okay? We good? All right, this is a very, very first step. Okay, now let's sort of jump into the concepts, okay? So most of the functions that we're going to be using in this class are all, for the most part, on the top row of the calculator. N, which is the number of periods, I divided by year, interest per year, present value, payment, and future value. We're also going to be using, down here, internal rate of return and net present value. Pretty much most all of the other keys on the calculator we're not going to be using, okay? Other than maybe, I guess we will be using, yeah, cash flow key, but outside of that, nothing else. Okay, so let's just start off. The way that your reading starts off, I think it's a good place to start, is to understand the concept of future value and what it basically is all about. All right? Future value is simply trying to understand what something is going to be worth in the future. Simple as that. Based upon a set of assumptions about today. Okay? And so, for real estate, the application is very simple. We buy a property today, we make an investment of a certain dollar amount, we want to hold that property for a certain period of time, we expect some sort of a rate of return. We want to know then how much supposedly it's going to be worth at some point in the future. Does that make sense? Conceptually. All right, so how do we get there? All right, well, conceptually, it's like this. All right, if we know what the current value of the property is today and what we're willing to pay for it, give me a dollar amount that we want to pay for our property. $1 million. All right, we're going to pay $1 million. How long do we want to own it? How long do we want to hold it? How many years or how many months?
5 years.
5 years. Okay, so 5 years. Now, do we want to calculate the return based on sort of monthly compounding or annual compounding? Okay, monthly, okay. So that means instead of 5 years, 60 months. Okay. Now, what sort of an annualized rate of return would we want to receive on this property over the time period we own it?
8%.
8%. Okay, so what we're going to be solving for is this future value 60 months from now. Does that make sense? Okay, so conceptually, this is what it sort of looks like. We're making a cash outlay or a cash outflow of $1 million today at time period 0, and then 5 years from now or 60 months from now, we want to know what the value is, assuming it increases in value at 8% per year. Okay? Now, setting this up with the financial calculator would be as follows. Okay? First of all, clear everything out. If your calculator is not currently set to 12 payments per year, we want to do that. All right? So, in order to do that, we're going to do 12 shift payments per year. So that gets it over to the 12 payments per year. Since we're doing this, we set on a monthly basis. All right? Clear everything again just to be safe. Make sure it's set correctly. All right? Then we're going to put in the information. 1 million. And we're going to put this in as a negative number, so we're going to use the change sign key, which is located over here on the left-hand side of the calculator. Okay? All right? Then we're going to put in 8% as our interest rate. And then we're going to put in 5 years, but we're going to hit the shift key and then the term, or N, and what you're going to see pop up in your display is 60. The calculator has automatically made the conversion for you, 5 years times 12 payments per year, or 60 months. Then we're simply going to solve for future value. What is it worth 5 years from now? All right? So there's the setup. I'll do it on this calculator here so you can kind of follow along. All right? So the shift, clear all. Okay, we're set to 12 payments per year. All right, so 1 million, change sign, present value. We said the interest rate was 8%. And we said the term was 5 years, so 5 shift in or 60 months. Then all we got to do is solve for future value. Okay? So what we should end up with is what we've got up there on the screen, which is 1,489,845 and 71 cents.
All right.
Yep.
How do you know again if it's on the 12-year, not 1 year? I know.
Okay. All you have to do is the shift to the clear all, and whatever it shows in your display. It'll show like briefly in your display. It'll pop up like 1p year or 12p year. If it says 1p year, it's on annual. If it says 12p year, it's on monthly.
It's on 12.
Okay, then it's set correctly. Then you're just going to hit the shift clear all, and then just plug and chug. Yep.
I'm getting like an E after a million when I try to switch it to a negative.
Okay. Once again, are you using the change sign key, not the negative key?
No, I think you're pressing shift the button because there's a little E.
Oh yeah, you don't want to do that. You're
click
not hitting the shift after you're hitting present value.
Okay.
Present value is the one that's PRC, right?
No, it has PV. Top row of the calculator, third key over.
Oh, PV.
Yep.
Okay. And then you just enter 8.
Just exactly like it's written here.
Okay.
Don't change a thing.
What's that S on that?
That's 5.
Oh,
After the,
that's your rate. Okay.
after the 5
No, that's your 5 year.
Shift and then N, which is once again over here,
Number of periods.
number of periods.
and then after that?
then you're just hitting the future value key right over here. You didn't type in the interest rate. Type in 8, hit the interest rate.
You multiply the interest rate to the after that, or you just.
Oh, okay. These three items here, think of it like this. These three items, present value, interest rate, and yield. Those are your three givens, okay? Think of it just like a formula. Those are the three items that you're putting into the formula, and what you're doing is then you're solving for future value. The order in which you put those three items does not matter, okay? All that matters is that you put them in correctly and then solve for future value. Now, if you're doing other things than what I have asked you to do in terms of pushing other buttons and that sort of thing, don't do that. Do exactly like I've got it up here. You're going to hit the shift, clear all, type in 12, shift, payments per year, hit the shift, clear all, and make sure that it's set up on 12 payments per year. Type in 1 million, hit the change sign key, then the present value key, then 8, then the interest rate key, 5, shift in, which should then give you 60 months, and then simply hit the future value button, and you're done.
Okay. All right. So that's what I'm trying to figure out. The interest rate key's not the percentage side.
No, it's the interest rate on the top row of the calculator. Second key over, right here, interest rate.
Okay. All right.
As I said, most everything we're going to be doing is on that top row of the calculator.
Okay.
All right? Are we good? Okay. Now, all right. So, what this is saying, this is kind of recap here, put the number up here, 1,489,845.71. So, very simply, we're saying we bought this property for $1 million, we held it for 60 months or 5 years, and it appreciated at 8% a year for that 5-year period. This is how much we would expect that it would be worth at the end of that 5 years, the future value. Okay? Questions? Okay. All right. Now, let's say we do something that wasn't in the textbook, but is a concept that you need to sort of understand, which is kind of a future value of what in finance terms is called future value of an annuity. By the way, just so you are clear, I did send out an email with the 10 topics that are going to be covered on the quiz, correct? Okay, that you should have gotten. So that should help to prep yourself for what we're going to be dealing with. All right. So this next piece, the future value of an annuity. Okay? Now, this gets used in real estate for a lot of different things, but one of the primary things that it gets used for is what's called a capital reserve or reserve for replacement. Okay? Now, what that means is, if you own a property, whether it's a residential, commercial property, doesn't really matter, there are things that you know within a certain period of time you're going to have to replace. You know you're going to have to replace hot water heaters. You know you're going to have to replace air conditioning units. You know you're going to have to replace carpet. You know you're going to have to replace, you know, a whole number of things associated with that property over, you know, the ownership period. Now, if you don't replace any of those things, you know, the property's not going to be in good working order, and chances of keeping it rented are going to be really difficult. So you pretty much are going to need to kind of plan for these sort of anticipated expenses. Now, hopefully, everything kind of outlives its normal useful life. So that, for example, a hot water heater might be expected to last, what, 5, 10 years, something like that? But you may be lucky, and your hot water heaters may last for 15 years, okay? But yet, if the time period that, you know, you sort of budget for is something less than that, you know, more of what they say that the anticipated, you know, time period is, you're not just going to go in and inherently replace them automatically. every 5 years. You're probably gonna wait until they stop working, okay? Same thing for air conditioning, same thing, for a lot of those sorts of things. But you wanna be sort of conservative and have that money set aside in a reserve account. Because here's what you don't wanna have happen. A lot of naive real estate investors, whenever they first start out, the very first thing that they're thinking about, oh my God, oh yeah, this thing is generating all this excess cash flow, I've got all this extra income coming in, and everything is wonderful, I'm making more money than I thought I ever could. And then all of a sudden, hot water heater blows up. Then air conditioning blows up. Then, they've got to replace the roof. Then they've got to do this, and they have no money to do it, okay? And then they go to the bank, and the bank says, we made you a loan on the real estate, we're not going to continually fund all of these, extra repairs and maintenance. You've got to be responsible for that. You need to be more responsible for that. And in some cases, what a lot of lenders will do up front is they will mandate what those reserves will be, especially for larger properties, okay? And say, you need to automatically set aside 10%, 15%, whatever the appropriate number is for a reserve account. Does that make sense? Yes or no?
Yes, sir.
Now, how we use it here financially is we basically are sort of saying, all right, we want to set up a situation of where we know we can set aside over the course of several years a certain dollar amount that we know we can afford, whether it's monthly, whether it's annual, whatever it might be. And so let's say that we can afford to put away $5,000 a year into a reserve account out of whatever income that we have coming in off the property. All right? And we want to know how much is going to be in that reserve account at the end of, in this case, 6 years. All right? Well, with that reserve account, hopefully we're able to put it in an interest-bearing account, all right, that, let's just say we can get 3% a year. And we want to know how much we're going to have in that account here at the end of year 6. Okay, does that make sense? Yes or no?
Yes.
Now, before we do any of the time value of money sort of calculations, let's just do some simple math. $5,000 a year times 6 years,
30.
okay, 30 grand. All right, so we know with an absolute minimum, we're going to have 30 grand sitting in that account at minimum, plus whatever accumulated interest we have with that 3% a year. Does that make sense? Yes or no? Okay, so it's just a check figure. If you get something wildly different from 30 grand, like below that, you know you did it wrong. And if you get something crazy large beyond that, you also know you've done something wrong. Okay, so let's just see what it actually is. All right. So in this case, this is going to be annual. So whenever we clear all, we need to now change it to 1 payment per year. Okay, and then clear all again, just to make sure that we've got it set correctly. So it's now going to be set for 1 payment per year. Now, here's the thing. The way this calculator works is everything that you put into it, like the number of periods per year, present value, future value, interest rate, all that sort of stuff, stays there until you erase it. So meaning, you turn the calculator off, you turn it back on, that problem that you worked on last week, that information's still in the calculator, okay? That's the reason why you've got to do this shift clear all, because it does more than just clear out what's in the display, it clears out all of those memory registers. Okay, does that make sense, yes or no? All right, now, so in this case, what we're going to do is we're going to put in 5,000, change the sign, make that a negative, and put it in as a payment, PMT. Okay, now payment just simply means it's going to occur probably more than once, okay? Same amount, over and over. That's why it's called an annuity, okay? An annuity just simply means it is something that in essence is going to be paid out over and over and over again, okay? All right, we're going to put in the interest rate, 3%. And then we're going to put in the term, 6, and we're going to hit the shift in. Now when we do the shift in this time, it's just going to be 6 because it's annual compounding. Now you can say, well, do we need to push the shift? No, you don't, but it's a good habit to get into because it's not going to hurt you, okay? And because if it's on monthly compounding, it will change it to, in this case, it would be 72 months. But we're doing annual, so it's just 6 years, okay? Then, solve for future value. Okay, so let's do it over here. Let's see. Payment. Percent. 6 years. And solve for future value. So 32,000, 342, 05. All right, so $32,342.05 will be what we have in the account after 6 years. Okay, so now very simple. You're paying attention. You're thinking about this. How much interest did we earn?
$2,000.
$2,342.05, okay? Everybody understand that? All you're doing is subtracting out the 30,000, okay? All right, we good? Nice warm fuzzy feelings? Okay, all right, good. All right, so let's move forward. So once again, all this is doing is make sure that I'm clear on the purpose of this, is this would be saying that we're setting aside a reserve for replacement of $5,000 a year for 6 years in an account earning 3%. So at the end of that 6 years, we're going to have this dollar amount available to us to be able to spend on replacing a roof, replacing an air conditioner, replacing whatever we need to on that property. Does that make sense? Okay? Because if we had not done this, where's that money going to come from? That's the issue, okay? So the whole, this is the thing. Let me also just another quick piece of advice. You know, whenever you're buying rental property, once again, whether it's residential, whether it's commercial, doesn't really matter in this particular instance. One of the biggest problems that people encounter is lack of basically funds to basically be able to deal with these sorts of issues, because the tendency is to take everything out of that property the moment you get it, pay the mortgage, and pay whatever other little expenses that you have to pay, and then take all the rest of it and spend it on something else, okay? That is like the biggest mistake you can make, okay? You really need to take almost every dollar that comes in off that property and pretty much just plow it back into the property, you know, not necessarily immediately, but plow it back in the sense of creating a reserve account that almost any excess revenue gets put into that reserve, whether you maybe need it or not, and then after the property is operated for a few years and you kind of get a sense for, okay, what you really need and what you don't, then you maybe can start, you know, taking out some money and being reasonably conservative with it, unless you just happen to have a ridiculous amount of free and clear cash flow to be able to constantly, you know, plow into it, okay, which a lot of people don't, okay? And then you end up losing the property because you can't end up basically making the payments or, you know, doing the repairs that are necessary, and then end up maybe in a situation of where you become a distressed seller, and then someone like Cole comes along and says, hey, okay, you know, you can't afford to do all these things that you need to your property. I'm going to relieve your misery. I'm going to buy your property at a deeply discounted, you know, value, and then, you know, you're going to end up being the one that hopefully does very well, okay? Yep.
I wanted to comment, that would also go for taxes and insurance.
Yes.
Because commercial loans don't do escrow.
They don't, yeah, they don't, I mean,
from my experience.
yeah, you're right. So, because of governmental requirements, restrictions, residential loans are treated very differently than commercial loans. Residential loans, there's all sorts of government protections. And basically the whole idea is to protect the consumer at all costs, okay? And to try to protect them from the unscrupulous lenders, okay? On the commercial side, it's almost all buyer beware, okay? Meaning that, too bad, so sad that you didn't do all these things that you should have done, and we're going to charge you for a bunch of things that you don't really understand because we can, because we're smarter than you in terms of the lender. And so, you know, it can really be a real interesting challenge for people to make that transition from, okay, I'm a happy homeowner, now I want to buy my first commercial property, and end up finding it's a whole different world, okay? And so the point that you're making is about the escrow or sequestering the funds for a residential property that normally most residential mortgages are ones where all of your property taxes and your insurances are taken out along with your normal mortgage payment and put into kind of a reserve account that so that at the end of the year, beginning of the year, that those funds are available to make those expenditures. Because realizing that, once again, kind of like I was talking about, a lot of the happy homeowners don't think about, you know, those sorts of expenses and then end up, oh wow, I didn't realize I didn't pay property taxes, I didn't realize I didn't pay insurance, I didn't realize, you know, and then don't have the cash to be able to do it and then end up getting foreclosed on. But on the commercial side of the business, yeah, you know, a lot of lenders just sort of say, okay, look, if you're not smart enough to put that money away, too bad, so sad, you know, we'll just foreclose on you, take your property and sell it and make a nice little profit on it. Excuse me. Question? Okay. All right. So everybody understands the value of this whole sort of putting aside money for reserve replacement. Okay. Moving forward.
What is the N mean?
The N is just the number of periods. Okay, so just well, I know that, but it wasn't, now it's working. Okay, so N is the number of periods. Okay, number of periods can be number of months, number of years. Okay, so once again, 5 years, obviously 5N, but if it's 60 months, 60N. Okay, then once again, present value key is just simply that, present value. The interest rate key, interest divided by year, is just simply, once again. Now, here's the thing about the interest rate. The interest rate can be called an interest rate, can be called a compounding rate, can be called a discount rate, can be called a growth rate, can be called a rate of return, can be called a whole number of things, but at the end of the day, it's a freaking interest rate, okay? But it's just different terminology that tries to be a little bit more accurate in its description of what that rate really is. If you hear it's a discount rate, then normally what we're talking about is converting a future value to a present value. If we typically are talking about a compounding rate, we're talking about basically taking a present value and compounding it into the future, you know, and so forth, so on. So it's just, but a lot of times very loosely, we just typically say it's the interest rate. Okay, Chase?
So also, like the interest rate is always entered as like a percent, not as a decimal, correct? Like if we get an interest rate and it says it's 0.03, we're going to put in 3.
Correct.
Like interest over year, not 0.03. We're going to apply a different calculation.
So for this calculator, the way that it works is you put it in as you would normally sort of see it
as a percent next.
Exactly. So that, as you say, if our interest rate on our loan is 5.75%, that is how we enter it. 5.75 interest rate. Okay. Now, in many cases, whenever we think about, you know, percentages, well, like if we were doing this and we were using like just a simple formula, in many cases we go ahead and we make that conversion and we say, well, it's actually 0.05 7.5. But the calculator, because it's meant to be a, I don't think the right word, a useful, functional device for the average person, they want it to be a simple to understand, which is simply put it in as it is. Okay? Make sense?
Makes sense.
Okay? And all this, and once again, you probably remember from your very basic math, all percent that actually means is really you're just kicking the decimal place over 2 points. All right? That's all that really percent sign actually even means. Okay? All right. Now, okay, moving on. So we got payment. Okay, the payment key refers to a dollar amount either being received by you or being paid by you. But it's a fixed dollar amount that recurs, like for example, a lease payment that you would make, a mortgage payment that you would make, that would be considered to be a payment, okay? And then finally, on the top row of the calculator, the future value key, as we have talked about, is simply what would we expect the asset, the property, the account to be worth at some point in the future, based upon these set of assumptions. Okay? Make sense? Move forward? Okay. All right. So the next topic, I believe I had listed, was simply present value. Okay? All right? So let's just say we have a situation of where we have a contract for somebody to maybe buy our building or for us to buy a building at some future date and time, okay? We make these scenarios up, you know, any which way we want to, but let's just say that we've got a property that, I don't know, 3 years in the future, we know that we can buy it for, give me a dollar amount.
1.3.
1.3 million. All right, so we can buy this property supposedly at the end of 3 years for 1.3 million. All right? What sort of discount rate we want to apply to this?
7.5.
7.5% discount rate. All right. All right, so now what we're going to be doing is we're going to be solving for the present value, or how much is it worth in today's dollars to us, how much could we afford to spend on it now, given that set of circumstances. Okay, so if we had the cash now, how much cash would we have to have in order to buy it for 1.3 3 years from now? Okay, you can twist and turn that a variety of different ways. All right, so in this case, to set this up, let's just say this is going to be 1 payment per year. Clear all. We're going to put in 1.3 million as our future value. Now, one thing to point out here, you saw in one of the previous examples, I put the present value in as a negative number, okay? And then the future value is a positive number, okay? There's a method to my madness here in terms of the way that I'm drawing out this timeline. Basically, anything above the line is a positive number. Anything below the line is a negative number, okay? And that's just to kind of keep things, you know, sort of you know, from an accounting perspective, inflows and outflows matched. Because your calculator needs, for every outflow, there kind of needs to be an inflow. There needs to be a matching of so that if we've got a future value as a positive number, what we're going to be paying for something or receiving for something, we need to know how much we're going to be paying for it up front, out of pocket. All right? So, 7.5% as our interest rate, 3 years as our term, and then we're going to simply solve for present value. Okay, what do we end up with?
1046,448.74.
Yep. Okay. Okay, so 1,046,448.74. So we're simply saying that's how much the property is worth to us today. I'll work it over here on this one just so that you can kind of see along. All right, so 1,300,000 future value, 7.5 as our interest rate, 3 years as our term, solve for present value. There we go. 1046, 448.74. Yep.
Why do we have a negative 10?
Okay, because that is, oops, sorry. That is going to be considered to be a cash outflow from our perspective. At times we need to have deposited today in order to have the 1.3 million 3 years from now.
Well, it's like compound interest kind of thing.
Yes.
All right, so you would have to either, for you to say you wanted to be a 1.3 million, you're saying you'd have to pay a lease or have that
Today.
today.
Because we've got a contract to buy it 3 years from now. So in other words, it's basically, we can approach this several different ways. We can say, okay, how much do we need to have today in a lump sum, which is what this is, a singular dollar amount, in order to generate 1.3 3 years from now. Or we could actually have this in a combination of actual payments over the next 3 years in terms of like how much we need to save maybe each year. We could also approach it that way. There's literally an infinite ways that we can kind of tackle it, but ultimately all we're really wanting to do is to say, all right, if this thing is going to be worth this amount at this period with this discount rate, how much is it worth to us today? All right. Yep.
Or you could say, if you had 1,046,000 and you needed in 3 years 1,300,000,
Right.
what rate do I need
Correct.
to get?
You would need to invest at 7.5%. Okay. So it's a lot of different ways to sort of spend it. Okay. But part of this, here's the thing. Those of you that are familiar with this sort of stuff, the thing that I think you understand, this is not math. This is logic. Okay. You know, all it is, you know, it's you're not really having to do any math. You're working with numbers, but all of this is logic. It's about what information have I been given, what am I being asked to solve for. It's as simple as that. Okay? But you've got to understand what information you've been given and what it is you're solving for, and then the how to get there is, in essence, how to put it into a calculator, how to put it into an Excel spreadsheet, you know, to ultimately come up with that answer. Okay? Because what you don't want it to be is that you are just trying to push buttons on the calculator and memorize keystrokes on the calculator, because that's not going to get you anywhere. Okay? You need to understand, you know, why you are using those particular functions on the calculator to get to whatever answer it is. And part of it is going to be a practice thing. Part of it is going to be, you know, going through some sample problems and kind of, oh, okay, now I understand. And then those of you that are brand new to this, you know, it's going to take a little bit of time. Others of you that have joined the program, you know, back in the winter of this past year, and you've taken the investments course, you're going to be ahead of everybody else because you've already seen bits and pieces of this, and you're like, okay, yeah, that's basic stuff, no big deal. Others of you are going to be like, oh my God, you know, this is so, you know, whatever. So just realize, you know, it does take a little bit of time to kind of ease into it. But right now, just kind of follow along, and it should be fine. Yeah.
So basically, out of any four of these numbers with 4 different type of categories here, I could use any one to find the other one. So if I wanted to find a percentage, I would use the 3,
Yeah. Okay. So for example, you remember what you know, we were talking about the very, you know, you asked the question, and you know the whole thing of present value is equal to future value over 1 plus the interest rate raised to the term. Well, in this case, same thing. We've got our future value is 1.3 million, and then this 1 plus 0.075. This is where it kind of gets into, you know, Chase's point from earlier, raised to the power of 3. And we do the math on that, and then ultimately what we're going to find is we're going to get the same answer. We're going to get 1,046,448.74.
and you could find, if, say for instance, we didn't know what 1.3 million was, but we had the other numbers.
Yes.
We could find 1.3.
Correct.
Or we could find the 3 to the.
Correct. There's a formula for each one. You're just flipping it around because you're basically got 3 knowns, 1 unknown.
Yeah, so any one of the, if you do the, what I was saying, I plugged in the different numbers different ways, it gave you back your numbers, whatever.
Yes,
numbers you left.
yes. Yeah, because it's nothing more than a singular formula that's just being flipped.
In the book, was that, what, to the power of 3, was that supposed to be negative? I think in the book it said
Yeah, power of 3.
No, it's not, no, it shouldn't be negative.
They had a couple
The
of numbers.
one-
Negative.
It was
Because
defining
it was
future
mul-
value.
Yeah, it was multiplying instead of dividing it, that's why.
Okay.
So they did the inverse
Yeah,
operation.
yeah, yeah. Okay, in that case, yes, it would be, but in this format, no. It's gonna be positive.
Well, theoretically, it's 1 over 1 plus I.
Yeah,
And
that's
you're
why,
finding a
we're not gonna,
multiple.
Math geeks.
no, it's fine, no, but
No,
you're
too.
engineering background, so I get it, you know, but the point is this, when I first started teaching this stuff 30 years ago, and we did all, like I said, we did all these formulas, and you know, it ate up so much time, you know, to calculate, to get down to something very basic, just like a present value or future value, as opposed to now, once again, punch it in on the calculator, you know, as long as you understand conceptually what is going on, that's what you need to know. As a real estate developer, you know, you don't need to know inherently all of the underlying formulas in terms of mathematics. You need to understand what those variables are, what they mean, how they sort of interrelate to each other. And sometimes the math can be the eye-opening experience for some people, but in a lot of cases it gets in the way of understanding fundamentally what's really going on. Okay, it sort of depends on how your mind works. Okay, but I try to keep it where it's all just about the logic of what we're doing. Okay, all right, moving forward. All right. So, let's say we want to do present value of an annuity. All right. So this is a situation of where we have like a rental rate that we want to find out what the value is of that rental rate or rental income. Would be one application of this. So let's say that we have a property all right, and we have a 7-year lease on this property. All right, give me, let's say, the annual lease rate. Give me a dollar amount. How much? How much?
12,000.
12,000. All right. Ooh, hello. Okay. All right, 12,000. There's another little concept we're going to talk about here. Okay. Now, let's say $12,000 a year for 7 years. Now, normally, and this is, I think, a really valuable concept, because I think some of you are going to ask this question before I even get a chance to answer it. You're going to say, okay, why are you showing all the rental income occurring at the end of the year and not at the beginning of the year? Because whenever you pay your rent, normally what do? You pay it at the beginning of the month, yes?
Yep.
For that month. Okay, this is where it gets interesting with real estate. With real estate, we typically don't, for accounting purposes, realize the income until the end of the period, or in many cases, the end of the year. And the reason for that is during that first 12 months of the year, what are you doing? You're receiving money, you're spending money, you're receiving money, you're spending money, and you want to know how much you actually have left over at the end of that year to be able to calculate your return. Does that make sense?
Yeah.
Okay, so the assumption is, yeah, you're probably receiving that 12,000 every month for the first 12 months, but we're not realizing it kind of from an accounting perspective to calculate a rate of return until the end of that year. Okay, is everybody clear on that? Yes or no? Okay. So, what we want to know is how much all that money is worth to us today. Well, let's just start with this. Okay, once again, another simple math question. $12,000 a year for 7 years.
84,000.
Okay. $84,000 is the actual hard cash currency that we will be receiving over that period. But if part of what we're wanting to do is to say, how much do we value that money at today? In other words, if this person, let's just say, I'm the landlord, you're the tenant. And you come to me and you say, I want to prepay all of my rent for the next 7 years. What sort of a discount might I give you on that rent to prepay me in one lump sum today? You're saying, that never happens. Yes, it happens, okay? One of the best examples, those of you that have had the investment special, you probably have heard this, so I'll keep it brief. Many years ago, well, actually let's just say like 1998, 99, the whole dot-com bust, that occurred, we had all these high-tech companies, created to, this is going to be the future of everything, and they were all being funded left and right by, different folks, but real estate owners in Dallas, Texas, specifically, I remember this, because I was living there at the time, basically were saying, we don't want to rent to you. We really don't want to rent to you because we don't believe that you actually have a future. Okay, the property owners were saying that because they were like, what's your business model? Yeah, you've collected all this money, but what are you actually making money on? And so the property owners were smart enough, many of them, to say, we don't believe you in the sense that, yeah, you've got money right now, but we don't think you're going to have money 2 or 3 or 4 years from now. And so those property owners said, okay, the only way I'm going to lease to you, you prepay your rent for the next, 5 years or 10 years. And so, okay. And so they collected all that prepaid rent. The company went out of business within a year or two. They had prepaid, obviously properties for the next several years that they didn't have to release, or they could release in some cases and not necessarily even having to give back the rent because the company was already out of business. Okay? But my point with sort of saying that is just to kind of get back to, if you were to have a tenant prepay their rent, what sort of a discount might you offer them, and what would that dollar amount need to be? Because what you're sort of saying is, I don't need to get all $84,000 from you today. I'm willing to maybe, get something less than that if you prepay. So how much do we want to discount it by? Give me a percent.
10%.
That's a little bit too much.
Yeah, realistic.
3%.
Yeah, something like 3% probably is not unrealistic. Okay, so we take 3%. All right, so we go over here. Once again, this is going to be on an annual basis. So 1 payment per year. All right, clear everything out. All right, then we're going to put in $12,000 as a payment, occurring 7 times for 7 years.
So this is money that you're getting back?
This is money you're receiving, or you will be receiving, okay, as the property owner.
Gotcha. So it's like as if there was already tenants in there.
In other words, once again, you're the tenant. Let's say I'm the property owner. I'm looking at this from my perspective. I'm going to be receiving $12,000 a year,
Gotcha.
net of expenses for the next 7 years from you. Okay, and 3% discount rate. How much is that worth today? Okay, we'll go over here. $12,000 payment. 7 years. 3%. All right. 74,763. 39. Or round you up. Yeah, go ahead, round. Oops. Oops. Oh, there it goes. Slow. Oh, 40. Okay. So what we're saying, let's make sure that we're very clear. Instead of them having to prepay the full $84,000 to us today, we would be willing to accept a discounted payment of $74,763.40 in today's dollars. Okay? Why are we willing to accept that? Simply because we're getting all the money now, and we can probably do something more productive with it than just a 3%. Okay? Make sense? And we have all the money right now. Now, we're not obligated to give a discount. We're just simply doing so because it might expedite the getting all the money up front. Okay? Make sense?
Could I use the same formula if I went to like a car dealership? It was like, we'll give you this today versus what you're trying to sell the car.
To a certain extent, but they, in many cases, yeah, chances of them, probably, you never know. In some cases, yes, there will be a cash discount, possibly, but they have all of their financing that may not even be done in-house. That's a whole other story in and of itself. I could spend hours on. I used to have, many years ago, I had a student that worked for one of the big sort of funding sources for General Motors, and General Motors automotive credit. And what they would do, this is fascinating. It's an interesting little story. So the person walks in to buy a car. And so immediately the dealership sends this request to GMAC, the financing folks, and says, okay, we want you to pull the credit score, we want you to do a credit rating on this person, all that sort of stuff. And then GMAC would then send back and say, okay, based upon your credit, your background, history, everything, we're going to give you a 5% interest rate. Okay? And so hold the phone for just a second. You, on the other hand, basically go through the same exact process. They come back, we're going to give you an 8% interest rate on your car loan because we view you to be more risky for whatever reasons, okay? Maybe your employment, whatever. Same thing for you, maybe 12% interest rate, okay? Now, what the dealership would then do is they had the freedom to go above and beyond whatever that standard rate. So instead of just charging you 5%, they could charge you 10%. Maybe they charge him 15%. And then make the difference off of whatever, and so you follow what I'm saying. That there's all kinds of interesting things that go on there, but it's a fascinating business. Okay, moving on. All right, so that would be the discounted value of that rental. All right, moving forward. All right, so next topic. All right, discounted cash flow.
DC.
All right, so one of the things that we have to do is typically try to, number one, take a look at how maybe a property has performed in the past, but also to predict how a property is expected to perform in the future, okay? And whenever we do that, basically what we do is we end up constructing sort of a nice little income statement and say, okay, for this next year we predict the income and expenses to be this. For the next year, this. The next year, this, and so forth, so on. And then what we then do is after we have made those projections for the next however many years, then we want to know, well, how much is that income really worth to us in today's dollars? Which is pretty much just like the problem that we just worked with one twist. And the twist is, those dollars may not be the same amount each year, okay? In other words, if you've ever owned a residential property or commercial property, even though your rent may stay constant, your expenses fluctuate. So the final dollar amount that you end up with at the end of the year is going to be, maybe a little bit different because maybe the utilities are different, the maintenance was different, the property taxes were different, the insurance is different. Everything is different, and so, or you may get paid late by a tenant or not paid at all or whatever it might be. The point is, from one year to the next, those income dollars and expense dollars fluctuate. So what we have done on the calculator thus far only assumes the dollar amount of income or the dollar amount of expenses is constant. So we need to have a way to deal with that non-constant income that varies, or variable income or variable expenses. And that is where discounted cash flow comes into play. All right, so here, what we're going to have is, let's say, okay, at the end of each year, we're going to have a certain dollar amount of income that we receive. All right, so let's just say, okay, you give me $1 now.
10,000.
10,000. Okay, small property, that's okay. All right, $10,000 the first year. What are we going to make it the second year?
12,000.
12,000. Okay, what are we going to make the third year?
13,500.
13,500. Doesn't have to go up, it can go down.
I was gonna say.
What do you want for the fourth year?
5,000.
9,000. Okay, and fifth year?
0, hurricane, took it out.
Oh, come on. All right, fine. 0. No, it's fine. All right, so those are our cash flows. All right, so how do we put this into the calculator and operationalize this? Okay, so if we, once again, we look at this on a timeline. What we've got is 10,000 here, 12,000 there, 13,500, 9,000, and the hurricane of Chase. Okay, that's 0. All right, so those are our projected income numbers for this property. All right, so once again, we're going to have to apply a discount rate to this. What discount rate do we want to use for this? 5%?
Yeah, 5.
5%. Okay, so 5% discount rate. All right, so what we're going to be solving for is, once again, a present value. But since we have these non-constant numbers, we're going to use a new function on the calculator, which is the cash flow function. Okay, so let's show you what we're going to do here. Okay, first thing, 1 payment per year. Split everything out. Okay, now, for the way the cash flow function works, the cash flow function is sequential in the sense that it goes from one period to the next, but it always starts with 0. Okay, and so in this case, for time period 0, nothing is happening, so we're going to make it 0. Okay, does everybody follow that? In other words, we're not getting any income right here, right now. We're getting our first batch of income, in essence, a year from now, of $10,000. Does that make sense? Okay, but the calculator just needs to start with 0 when we start inputting this. So what you're going to do is you're going to put in 0, and then you're going to hit a new key, the cash flow key, CF sub J. Okay, hold on, I'm going to show you where it is. Okay, so over here in the calculator, third key over, third key down, CF sub J. Everybody see it on the calculator? Mm-hmm. All right. So that just simply means that is, and whenever you hit 0 and then the cash flow key, it's going to probably pop up in your display real briefly, CF0. Just simply meaning, okay, cash flow for time period 0. All right. Then we're going to put in 10,000. Hit that cash flow key again, and it should pop up in your display CF1, meaning cash flow for year 1 or period 1. You want to jump ahead? 12,000 CFJ, 13,500 CFJ, 9,000 CFJ. And we really don't have to enter it, but we're going to just because we should. Enter that final 0 because it's not really going to have any impact. Okay? This is no income. All right? So we've got all those entered. Then what we're going to do is we're going to enter in the discount rate. We're going to type in 5, and then the normal interest rate key up on the top row of the calculator. Then you're going to hit the shift key, and you're going to hit the net present value key, which is another new key, which is right underneath the PRC key. Right here on the second row, fourth key over, you see NPV. So we're hitting the shift key, and that is going to give us the value today of that stream of cash flows. Now, go ahead and do that. Let's go ahead and get that number. I get 39,474.29. Okay? Yep.
So you said the last zero is not required, but don't you have to put it into account for the 5th year?
Not necessarily, because since there's no income there, it's not going to be discounted. So whatever discount rate we apply, it's basically still going to be zero.
Yeah, because you multiply.
Yeah. So it's just irrelevant. Now, if we had, but here's the thing. If we had let's say a 6th year that was positive, it would become relevant because we would have to show that it was zero for that year because then the following year. So that's why, you know, I almost wasn't going to allow it because I don't want to screw with your head any more than I have to. Okay. All right. Now, so let's just do some simple math here. Chase, since you're really good at this, add up those numbers for me in your head.
22, 35 and a half, 44,500 dollars.
Okay, is he right? Yeah. Okay, so 44,500 would be the raw amount of income that we would be generating off this property, but the discounted cash flow value would be 39,474. Simply telling us how much is that income worth to us today, much like the previous problem. The only difference between the two is these numbers change from year to year or period to period, whereas the other stay fixed. Okay, make sense?
So is that like what, like if we could know that that's what the cash flow would outlay, that's what it would be worth for us to pay for that property?
It's what the value of the income stream is worth on the property.
Gotcha.
Now, and I'm very specific with that because the next piece of this is to talk about reversion value or the sale price of the property. Okay, this just tells us what the operating. So here's how you make money off of real estate. Okay, a couple of different ways. Let's just walk through this, and it's really important to focus on. One way that you make money off of real estate is off of what we call operating cash flow. Okay, which is simply that day-to-day kind of rental income and expenses sort of cash flow. You make money off of real estate that way. The second way you make money off of real estate is when you sell the property and you get money off of what is referred to as the reversion or the reverter or the selling price or the future value, whatever word you want to use, but in many cases we use the word reversion, meaning that the money that you have put into it now reverts back to you because you sold it. Does that make sense?
Is it the same as your equity that you're just cashing out?
It's not, well, because you're getting back your equity, but you're also getting any additional money paid in above whatever expenses you've had as well. In other words, you're paying yourself back your equity, yes, but then you're also paying yourself anything above and beyond that that you've generated whenever you sell it.
So the new equity is the reversion, I guess, the equity that you've gained?
Yeah, you could sort of say it's equity reversion.
Okay.
But it's if we don't, well, on this one we don't have a dollar amount that we put into it because we didn't structure it that way. But yeah, you'd be getting back whatever you put into it, hopefully, and additional money on top of that. After if you've had a loan on the property, pay off the loan, selling expenses, so forth, what would be that dollar amount that you would be basically getting back? And we're going to work through an example.
And you could call that capital gains too?
Oh boy, see,
Sorry.
this is, no, okay, this is where we get into the sort of what, in the real estate investments course,
Yeah.
where we specifically get into, okay, what is considered to be a capital gain, what is considered to be recaptured depreciation, and, you know, dealing with how that kind of gets sliced and diced because they get taxed at different rates.
Right.
So, I mean, yes, on a very simple basis, no taxes involved, yes, the dollar amount that we would sell it above and beyond what we paid for it would be technically a capital gain. But because of depreciation that we get to take for tax purposes, then it becomes something very different. Okay, which we get into in detail in the investments course. This course, that's one thing to sort of point out the difference between the investments course and the finance course. This course is all about the debt side for the most part. It's all about the lender, it's all about the loans, it's about the structuring of the loans and the rates of returns on the loans to the lender, that sort of thing. Whereas the investments course is all about everything on the equity side of understanding, okay, about the investors, about how they get paid, when they get paid, how much they get paid, what the tax implications are of them getting paid, and so forth. That's kind of how we kind of divide the two. Yep.
Do we factor in inflation and say 39,474.29 is worth more today than 44,500?
That's in essence kind of what we're doing with that discount rate.
Yeah, that's included.
That's really what that discount rate of 5% is meant to be sort of taking into account. Part of what it's taking into account. It's taking into account sort of an inflation rate as well as a real rate of return.
Expected rate as well.
Okay? Make sense? Okay, yep.
Would you include a third way to make money on real estate as depreciation as a third way?
Yeah, I mean, yes, in the sense that there are definitely some tax advantages to, which we will get into, yes, in the real estate investments course, but yes, you could.
One of the best tax advantages.
We get into all the tax stuff, trust me, in the investments course. But we don't have enough time to talk about both of those in this course. Okay. Yep.
Why did you do the net present value if there was no initial investment?
Okay, because we're wanting to find out what that present value would be, or what it could be. In other words, we're simply saying, much like we did on that previous problem, where there was no initial investment either, it's simply saying, we want to know what the value is of those future cash flows in today's dollars. The only difference between this example and this one is just that we have a variable dollar amount that we're receiving each year.
Or using that present set of
Right. Now, we're going to get a little bit deeper into that where we will have an initial investment and a reversion value and so forth, so on. That's sort of where we're headed. Okay. All right. Now, let's see, where are we? All right. So let's talk about reversion. Okay. So, let's say we've got a situation of where we've got, for each year, I'm just going to throw some numbers down here. Well, they are going to be the same. All right. So each year, we sort of see our income grow $2,000 a year, okay? Not by a percentage, but just by a dollar amount, okay? It could grow by a percentage, could grow by a dollar amount. Either way is fine. Now, what we want to know is what this property is going to be worth here at the end of year 5 is when we want to sell it. We want to know what the reversion value is right there. Okay, does that make sense? Because that's when we want to sell it, is at the end of year 5. Okay, so if we sell it at the end of the year 5, what we typically are going to want to know is what is our expectation for future year worth of income and growth, okay, and discount rate and so forth.
Beyond our years. That's what
Beyond year 5. Because think of it like this. Assuming you're the purchaser here at year 5, okay, end of year 5, and you're wanting to buy that property with what are called income, backed expectations, all right, in the sense of the future income is what matters to me, or it's current income, but yet we're also concerned about what the future is going to be, in each successive year. So what we're going to do, as a matter of convention, is we typically then estimate what the following year income is expected to be, which in this case, we're just gonna say, okay, it increases by another $2,000, so it's now 20 grand, okay, is what we expect next year's income to be, and that's what we wanna buy or sell the property for at the end of year 5, based upon that next year's income. Does that make sense?
Yeah, but.
Okay, hold the phone. So if that's the case, then what we're doing is we're basically applying that same little model, the ERV model we talked about at the very beginning, where in this case now our year 6 NOI is going to be 20,000, and then we apply some sort of a cap rate to this, which once again be our discount rate minus our growth rate, and let's just say if that lands on 5%, okay, or 0.05, 0.05 or 5%. Then what we're doing is our reversion value is going to be basically based on that calculation. So what we're going to be doing is simply taking the 20,000 expected future income divided by 0.05. So that's saying the property should be valued at the end of year 5 at 400,000, okay, based upon that income expectation, okay? Does that make sense?
Yeah,
Okay?
but
Isn't that the same as saying a 6-year gradient starting at 10 with 2 added every year?
You could, but, okay, for the purpose of what we're doing, all we're simply saying is that in this case, our cap rate is the 5%, but broken out, what we may be saying is something like, let's just say it's a 7% discount rate and a 2% growth rate from that point forward. Okay, that's not inherently, accurate, but it's for the purpose of the example, for the purpose of the problem, for the purpose of explanation, that's really all we're doing. Because if I give you the discount rate and I give you the growth rate, then you're going to be able to calculate, obviously, the cap rate to be able to do the calculation. All right? Make sense? All right. Moving forward. All right. All right. So, next one, NPV. And this one is going to be making the assumption that we do have, I'm going to do some variable payments. All right. So how much do we want to buy a property for at time period 0?
1.2 million.
Okay. 1.2 million. So getting back to your point earlier, this is now where we're going to have an outflow here at time period 0 of the purchase price. Okay, how much is it going to generate each year in income?
50,000.
Okay, 50,000. But let's say that it generates 50,000 for the first 2 years, and then maybe it jumps up to, I don't know.
75.
Yeah, sure, why not? All right. Now, in this case, how much do we think we might be able to sell it for in year 5, the reversion value? And I'm not asking you to go through and do the calculation we did. Just give me a number.
1 million?
Let's say 1.5 million. That's what we listed. Okay, so we sell it for 1.5 million at the end of year 5. Okay, everybody cool with that? All right. Now, let's do the simple math for a second. I'm just adding up everything. So let's just take 50,000 plus 50,000 plus 75,000 plus 75,000 plus 75,000 plus 1.5 million. And adding all those up, we get 1,825,000. Yes? Chase?
You really want to do this right now?
Okay, so that is the total amount of income that it generates, okay, in just raw numbers. So if we subtract out our original purchase price or investment, that leaves us with $625,000 in sort of net profit or net present value, assuming no discounting. Okay, does everybody follow that?
Yep.
Okay, so this is, just doing the raw math to get a sense for, are we actually making any money off of this or not? Well, we are. We're making $625,000 in raw dollars, but we got to discount that to see how much it really translates into. All right. So, putting this in on the now the other thing. All right, we need to know some sort of a discount rate that we want to apply to this. So, what sort of discount rate we want to use? 4%. We've used 5%. We've used 3%. So why not 4%? 4%. Okay. So, putting this on the calculator, much like the previous problem, one payment per year. Clear everything out. Then you're going to put in $1,200,000 as a negative, or change the sign, cash flow. Put in $50,000 as a cash flow. $50,000 again as a cash flow. $75,000 as a cash flow. Now here's a little, I'm not going to do that. Okay, I was going to show you a shortcut, but I don't want to confuse you. All right, put in $75,000 again. And then for the final amount, and this is where most people screw up, you need to add the final year cash flow to the reversion. In other words, because you're getting both of those dollar amounts at the same exact time at the end of the 5th year. Okay? So they count as a singular cash flow, because if you put one of them in as year 5 and then one as year 6, it ain't going to work. Okay? So that would mean $1,575,000 as your final cash flow. Then you put in 4% as your discount rate. Then you're going to solve for net present value. $319,624.97. Okay, so let's talk real quickly about what that means relative to that. All right, so we set up here in terms of raw dollars in, raw dollars out, with no discounting applied, $625,000 profit. Okay, sounds great, yes? But then after we apply a 4% discount rate to all of those future cash flows, that lowers our profit by but lowers it down to $319,000. Okay? Now here's the way you should look at this. In essence, you could look at this a couple of different ways. All right? One is, what does this 4% really represent? Okay, if it's truly just a discount rate that you're applying to account for risk and inflation, but you're using all cash, you're actually getting a 4% rate of return, plus you're getting the $319,000, or in reality, you are getting the full $625,000. Is one way to look at it. Okay, but if you're borrowing this money, and your cost of borrowing is, let's say, 4%, then the money that you're getting above and beyond that cost of borrowing is $319,000. Or you can look at this as simply an internal hurdle rate of, I want to get a 4% rate of return on my investment, and as long as I get that, I'm going to be happy. So if I get that, and I get something greater than that in terms of a dollar amount, then I'm super happy. Okay? Let me sort of show you what's going on here, because this will help to kind of demystify some of this, okay?
Really quick, can you show what the shortcut was supposed to be?
Okay, so you could do, and it's not without worth doing because these are only occurring a couple of times, but like for example, we could have, after this first 50,000, we could have then done, oops, right pen on there, to shift in subject. And that would mean that the 50,000 occurred twice, and you wouldn't have to put it in here. And then for the 75,000, same thing, you put in twice, because you're still going to have to put in the reversion. So it's really not much of a shortcut, but like for example, if you were putting in entire, let's say, years worth of data where every year, that within the year, you've got maybe for 6 months it's this amount, 6 months it's that amount, you know, another 8 months it's this amount, then that shortcut of being able to do that cuts down on the number of calculator keystrokes you've got to put in.
In the last example, what were you showing compared to this one? Like, are you just going further and finding the net present value of?
Yes, because this one actually has an initial purchase price, whereas the previous example did not.
Okay.
It's basically saying what would in essence the net present value, you know, well actually that's reversion. I'm sorry. This one was yes. This one was just finding out what the net present value is without any sort of expenditure at time period 0.
I was talking about the one. Yeah, that one right there.
Okay, no, that. Oops, sorry. That is just simply calculating the reversion value. What the reversion value would be at the end of the 5 years.
In other words, how you get to the reversion.
Right. Okay. This one's giving it to you. Okay. Okay. All right. So let's say that we've got all this stuff put in here for a second. This is, I think, some of you, this will kind of where everything will kind of begin to gel together. All right. If we were to follow on here, don't erase anything, just follow on from right here, and you were to put in 0 as the interest rate. Anybody want to take a guess as to what your NPV would be?
625.
625. Because you're not discounting it. Okay? It's just whatever dollars in, dollars out. Okay? 0% discount rate means no adjustment. Okay? Now, if you were to raise it, let's just say, I don't know, I'm just going to pick a number at random, 15%.
Ooh.
Let's see what happens.
Let's see what
Let me focus to do it on the calculator.
But that's because an exponential you could raise to the 0 is equal to 1, so you multiply by 1.
Okay, so 15% is going to be 200, negative, I think 243,465.99. Let's put it at 10%, see what happens. Negative 27,000, it's important it's negative, 697.44, okay. Let's put it at 8%. I'm doing what I'm doing for a reason.
75,746.
Positive.
Are you trying to get to 0?
Yep. No, I know how to get there, but I'm trying
No, I know, trying to.
what I'm trying to do is show you the process of an interpolation to kind of get to that point.
Okay.
So basically, what we're seeing is somewhere between 10% and 8% is where the net present value equals 0, which means that's what the internal rate of return would be for the property or for the investment. Now, we could actually solve for that, what that percentage is, just by shortcutting the whole process and use shift internal rate of return for the year, which is underneath the CST button, So shift, internal rate of return, so it's actually 9.44323%. Okay? So all that means is,
Yours gives you that many.
I'm
Like
sorry?
mine just stops at 9.44.
thank you for that. So what you do, hit the shift key, and then underneath the equal key is DISP for display. And then hit 9. What that will do is that will kick your calculator decimals out to 9 decimal places.
Where's that?
Significant
Okay.
figures.
So shift,
Second
underneath the
equal sign.
equal key, over here, underneath the equal key says DISP. So you hit shift, equal, 9, and then now it kicks it out to 9 decimal places.
Could you explain that whole sequence again?
Or just like what the IRR exactly is like.
Yeah, I'm about to get there. Okay.
Does it necessarily have 9 digits? Because I'm
No,
used to 4.
I'm not worried so much about your rounding, trust me. Rounding is not going to be the concern. Okay, so here's what's happening. Let me try to illustrate the point.
Significant figures.
Okay.
Well, bonds and things like that.
Okay, so here's what actually is we were trying to do here, what I'm trying to illustrate with this whole little high-low game with the interest rate. All right, we have our set cash flows, okay? Those are set, okay? What we want to know, or part of what we want to know, is what sort of a rate of return are we receiving on those cash flows? And there's a variety of ways to look at it, okay? One way that we are looking at it, as I was explaining earlier, was to simply say, all right, we're going to discount those cash flows by 4%, and we're going to see how much they're worth to us today in terms of above and beyond what we initially spent, how much more could we have spent up front and still have achieved 4%. That's what that number represents, okay? Whereas in terms of a zero discount rate, what we're saying there is we could have spent an extra $625,000 here up front, and then we would have matched perfectly with the actual dollars of income generated off of the property. Does that make sense? Yes? Okay. Then, randomly, I said, okay, well, what if we required a 15% rate of return? What would that mean? That would mean, because this is negative, we overspent by $243,000 up front if we wanted to achieve a 15% rate of return. Okay, is a way to look at it. 10%, same thing. We overspent by $27,000 if we wanted to get a 10% rate of return on this property. Okay? Then I said, well, what about an 8%? Well, now we're back in the positive again, and in essence, we underspent by $75,000 if we want to get an 8% rate of return. But now, what if we don't want to underspend or overspend, and we want to hit the nail right on the head with precisely a nice match of income relative to the rate of return that we're getting? That's where the internal rate of return comes into play. And it's saying what you're actually getting with this set of cash flows is a 9.4% rate of return over that 5-year period. Does that make sense? So you haven't overpaid, you haven't underpaid, but that is your rate of return that you're getting, and at that point, your net present value is going to be 0. So if we were to put in this rate, if you were to put in 9.4323 as your interest rate, and then you solve for net present value, you should get pretty darn close to 0. Because it's simply saying your outflows, in essence, are matching your inflows with respect to that 9.4% rate of return. Does that make sense?
Yes.
Okay? All right. Moving forward. Why don't we take a 5-minute break? Okay, 5-minute break, so come back at 10:45. Yep.
Double check. No, I'm kidding. Wait, were you done?
Just slide, bro.
I was thinking that.
Try clearing it out. Look at this, shift clear all, putting everything in one more time. Just make sure that you didn't enter something incorrectly.
Well, you know, after you remove this 0%, if you wanted to start from this 625,000, you have to start from the whole formula again and just skip the interest before we start off that point.
You can start with that one.
I have what you were doing, you just.
You can skip this step right here.
Okay, so let's skip that whole step above your hand.
Well, you can't do that.
Okay, so you would have to redo it over.
Yes, yeah. Yeah. Yep. You're doing the same thing. Okay, well, maybe see if I can. No easy way to get over there.
Let me see, I think you would have gave it to the last day of class or the day after.
All right, what you do?
I don't know how to like the teacher yet, so after I get my grade.
Think we grade him after this, right?
Nope. Okay, that's what you're doing. That's why I told you you can't do that. You got to add that to the 1.5 million. Because that's the final year cash flow. It all gets combined. So you're going to take 75,000, add it to the 1.5 million, just put plus 1.5 million. It equals cash flow, and then solve. Yep, 4%.
Oh, I was doing
Yep.
this and then.
Yep. Okay, that's not what I put. You see, look what I put.
Oh.
Yep.
Can you scroll down to the IRR part? I just wanted to see if I could please.
You said if we did 9.4, which was very close to 0.
Yeah, if you put that in as your interest rate, you should get very close to 0.
So when you change the payments for your from 1 to 12, usually that happens when in the problem they ask you that the account balance off.
Paper's okay, brother.
Okay, we're still missing 1 or 2 people, but we're going to go ahead and put 10:45, right? Yep, 10:45. Okay. So, the next topic, net future value, also not covered in the book. All right? Now, Now, in this case, what I'm going to use, your calculator doesn't have really a net future value key, and we're going to do this a little bit different. Really, we're searching for the future value of an annuity, but it's the same thing. Here's what we're really doing. All right. Let's say that you bought a piece of raw land. All right. And that piece of raw land, how much did you pay for this piece of raw land? Give me a dollar amount.
10,000.
It's a small amount. $2 million.
Good price.
Okay, we're going to go with the 10,000.
Got it on the tax sale.
All right, so 10,000 is what we bought this piece of raw land for. And then each year, that raw land has holding costs. In other words, you got to pay what? Property taxes, probably insurance. You know, you got to keep it mowed, you know, maintained, fenced, all that sort of stuff. So your annual sort of holding costs are going to be, I don't know, let's say that's why with $5,000 it's almost, let's just say it's $1,000 for holding cost. Okay, so annual holding cost. All right, so land purchase price. Okay, and let's say for all of these expenditures that we make, we want, in essence, a certain rate of return that when we sell the property, we're going to recoup everything that we've spent, plus we want some sort of a fixed rate of return. And so in this case, we actually want a decent rate of return. So let's say 10%? 10% annual return?
Yes, sir.
Okay, 10% annual return. And how many years are we going to hold this thing? Let's say for land, you may hold it for 10 years. So everything is a factor of 10. So 10-year holding period. Okay, so once again, to recap the scenario, what we're doing is we're saying, all right, we're going to calculate what we're going to refer to as our net future value of the property. And so we bought a piece of land, just raw land. We paid $10,000 for it. Obviously not a very nice piece of land. And, or somewhere, yeah, anyway, that's a whole other thing. $10,000 piece of land. Every year we're going to have annual holding costs of property taxes, insurance, maintenance, whatever else that we're going to have to pay out of pocket. And we are going to want a 10% annual return on whatever we have spent, and we're going to have a 10-year holding period. So the question is, how much do we have to sell it for to satisfy that? Does that make sense? Okay, so we've got 4 input variables, 1 output. All right? So let's just sort of start with a nice little timeline to show what we've got going on here. So we've got negative 10,000 that we're spending here at time period 0, and then end of each year, 1,000, 1,000, all the way over to 10 years. Okay, so $1,000 a year for each of those years. We're wanting a 10% rate of return, and so we want to know what is our net future value, or future value, okay? So all you're going to do is 1 payment per year, clear everything out, $10,000 as our negative present value, 1,000 as a negative payment, 10% as our interest rate, 10 years as our term, solve for future value. Now, one thing before you start punching away, one thing that you need to kind of make sure that you're thinking about here, both of these have to be negative numbers, because both of these are cash outflows to you. So if you were to make this one positive or this one positive, it's going to throw everything off because these are both expenditures, okay? Does that make sense? So they both need to be negative.
What's the 10 and then the very last one?
Shift in?
Oh, that's in.
Yeah. I'm sorry. I do tend to be a bit non-precise with my lettering sometimes. Okay, but it is in. Yes.
What?
So in reality, you're going what that 10,000 future value is and what that annuity future value is, and then adding the two.
Yeah, or just do it all in one fell swoop.
Okay.
Yeah, which is what we're doing. So in this case, let's just do it. $41,874.85. Now, let's just, for fun, once again, do the simple math. We have our initial expenditure of $10,000, initial, and then we have the $1,000 times 10 years, so another 10,000 cash flows. Oops. So that means we've got $20,000 invested in this, and we're basically, we're really, because of the compounding and of the 10% rate, that means that we would have to sell it for $41,874.85 in order to satisfy our requirement of the 10% rate of return for every dollar we've invested. Here, my point with doing this specific kind of example is, a lot of land investments are horrible. Horrible. Because what happens is, you have some people, they may buy it at what was a bargain price, but if they hold on to it 10, 15, 20 years, and they've got all of those sunk costs of property taxes, insurance, and everything else, that, after 10, 15, 20 years, they've got to make so much more on the sale of that property than what they have in it. In many cases, it just doesn't make any sense. I mean, because what you typically will hear from I remember this, growing up, I don't know how many times I would hear people talk about, yeah, I bought that farmland, and I bought it 50 years ago, and I only paid $10,000 for it, and I sold it for twice what I paid for it last week. Selling it for double over a 50-year holding period is almost nothing in terms of a rate of return, okay? But people's mindset, in many cases, is predicated on what they bought it for, what they sold it for, and ignoring holding period, okay? Holding period is probably one of the most important things of all, because you've got holding costs. Time is money, literally, So the longer you hold something, like for example, let me just give you a super simple example. Let's say, we'll make it even a non-real estate example, so you can maybe even relate even easier. Let's say you bought a car for $10,000, and your intention was to sell it as quickly as you could, all right? But let's say you sell it for twice the price of what you bought it for. So you bought it for $10,000, you sell it for $20,000. All right? Now, ignoring time for a second, that would be what? 100% rate of return. Yes?
Yes.
Right. Ignoring time. Now, if you sold it in precisely 1 year from the time you bought it, that would be a 100% rate of return. But if you sold it 6 months from now, it's actually a 200% rate of return. You follow me?
Yep.
Because you've only held it for a year or half a year. But if you sold it 2 years from now, that return goes down to a 50% rate of return. And then keeps going down the longer you hold it. So in other words, if you held it for 10 years, in essence, it's really only like a 10% rate of return. Okay? Everybody follow? Now, it's going to be off a little bit because of, obviously, the compounding effect, but just in general, it's what I want you to wrap your head around, because, whenever it comes to land deals, a lot of people, their whole intention is, oh, okay, I'm going to buy this, and I'm going to buy it in the pathway of where the new growth is occurring within the city or the county or whatever it might be, and I'm going to hold on to this for the next, 10, 15, 20 years. And, you know, once again, on the surface, it may seem like a great deal, but then once you factor in all those extra holding costs, it may not be. Now, let me rewind the tape just a little bit. What if it's agricultural land?
Yeah, that's what I was about.
See, no. If it's agricultural land, you have a different spin. Because with agricultural land, your taxes are much less, if almost non-existent, okay? And so therefore, what happens with a lot of developers is they will purposely buy agricultural land, keep it zoned agricultural land as long as they possibly can, and do whatever they have to maintain some sort of agricultural use. I mean, I saw some just amazing things in Texas with this.
Cows.
Yeah, literally. No. You would have to either grow crops on it, you or have to put livestock on it, something to show that it's truly agricultural land to get that agricultural exemption on the property taxes. But the whole reason for doing it is to lower those basically holding costs to an absolute minimum, so that at least you take that piece of it out of the equation, okay?
The reason I understand where you're coming from. If you're buying something in a city and you're speculating on land, tract land between neighborhoods, that falls into it. But I've done research for the Village of Wellington when I worked there, and looking at before the city of this is crazy. Before the city of Village of Wellington was formed in the 1970s, it was all farmland. So they sold off tracts of land, like acres or 2 acres, for $1,000 in the 1970s. In 1999, these people were selling these tracts of land for about $1 million to $2 million.
Yeah, and that's the exception to the rule, where you have such a radical sort of price transformation that makes it worthwhile. But in a lot of cases, it's not that kind of radical sort of price transformation. It's enough to where it looks sort of interesting, but it's not always as wonderful as what it initially looks out to be. Okay, so that's the purpose of this little net future value calculation.
Is the 20 grand, is that the expenses right there?
Yes, your actual out-of-pocket expenses in raw numbers. But the fact that you're demanding a 10% rate of return over that 10 years, that's what drives up the selling price to need to be $41,000. But like, for example, I don't know if I've already put my calculator out. Let's just see. Nope, I didn't. So let's just say that we only required a 5% rate of return. Then we would only need to sell in the future at 28,866.84. If we demanded a 0% rate of return, then we would only need to sell it with what we basically have in it. Does that make sense? Did that answer your question? Okay. All right, any other questions? Cool, comfortable? Okay. All right, okay. So, let's say that we have, and this is going to be solving for number of periods. Also not in your book. Okay, so here, let's say that we bought something. Okay, what dollar amount do we buy it at?
$750,000.
Thank you. Okay, what amount do we sell it at?
1.5.
How much?
1.5 million.
Oh, I think you said 9.5.
That's better.
Big numbers. Okay, 1.5. All right. And what sort of an interest rate do we expect that we might be able to obtain? Or rate of return?
6%.
6%. Okay. So this becomes our present value. This becomes our future value. And then this is obviously our interest rate. And then we solve for N, or number of periods. Okay? Now, in this case, let's say we want to make it monthly, just for fun. So we would do 12 shift payments per year, clear all, and put all of this in. Okay, let's see what we end up with.
750 not a negative number?
It is. Oops. $138.975. So in essence, rounding up, 100.
975.
I'm sorry.
975.
Okay. Did you change to 12 payments per year?
Yeah, I got 976. What kind of rounding rules?
Oh, okay. I wasn't rounding. I was just writing out what was there. I didn't round. But yes, it would be 976 if I remember.
Thank you.
Sorry. Screwed me up here. Okay. 139 months, rounded, okay, would be what it would take for us to get there. Okay, does that make sense to write?
So 12, and then the shift, and then
Payments per year.
it's still when I re-clear it, it still is at 1.
Okay, make sure you're doing 12 and then shift payments per, which is basically the payment key. And then hit shift clear again, make sure that it did it. Okay, so what this is telling us, 139 months, which would be how many years, Chase?
Oh my god.
10 years and
A little bit over 10.
11 years.
Yeah,
I don't
11
know.
years and almost, yeah, not quite 12. So 11 years and some odd change. Okay, so basically to double our money from 750 to 1.5 million at a 6% rate is going to take us that amount of time. Now, just once again, just for fun, let's say that we change that rate to 10%. What's that going to do? It's going to shorten the amount of time that we actually have to hold this investment. So let's see what it actually shortens it to. 83 months. Okay, so 83 months divided by 12 is like 6.96, so basically 7 years roughly versus 11 years roughly. Okay, does that make sense? Now what if, just kind of for fun, we were to get 15%? $55 months. Okay. Or like 4.64 years. So we just kind of keep going and going and going. You know, obviously, the higher the rate of return that we could possibly achieve shortens the amount of time that we would actually have to hold it. Does that make sense? Okay. Everybody comfortable? Okay. All right. So one more type of problem before you are adequately prepared for the quiz, but we're going to do some other sample problems before we do that. All right. So solving for a payment, or basically calculating a mortgage payment. All right. So give me first of all, we're going to do 12 payments per year. This is, let's say, is a mortgage. All right. So give me the dollar amount of the mortgage that you want to do. This can be as big or as small the number as you want. 1650. 1650? I'm talking about the dollar amount of the mortgage. Not the mortgage payment.
Oh, okay, gotcha.
1.2 million.
No, it's like 19 minutes.
Okay. 1.2 million is going to be our loan amount or our present value. Okay, what interest rate are we going to use?
3.5.
Just mental.
3.5 is going to be our interest rate. All right. What's our term?
Term of 10 years.
10 years. Okay. Then we're going to be just simply solving for what is the payment. Okay.
So we're keeping that 12 months, right?
Yep. So our monthly payment will be $11,866.30. Okay, that makes sense, everybody? So all we're doing here is this is simply a mortgage payment, much like you do a car payment, much like you do any sort of loan payment. And so on our little timeline of sorts, what this is going to look like is, all right, we're getting this mortgage for $1,200,000. We're receiving that money from the lender here at time period 0, and we are going to be paying this off over 10 years or 120 months. The interest rate, 3.5%. So what we're solving for each month is what is our payment all the way up to payment number 120. What is our payment each month? And that's where it would be the $11,866.30. Does that make sense, everybody? Yes or no? Okay. Now, let's put that in more. Well, let's just play around with that. All right. So, just using your brain for a second, not the calculator. What if we increase the term from 10 years to 30 years? What's that going to do to our payment? Up or down?
Decrease it.
It's going to decrease it because we're having to pay less money over a longer period of time in terms of the monthly payment. So in this case, 30 years, resolving for the payment. So our payment would go down to $5,388.54. Now, why is that important?
I mean, it would just help out depending on what your cash flow status is.
Perfect.
Or if you refinance a home.
Okay, but your first answer was really good, because in a perfect world, you as a borrower want to try, and I said in a perfect world, my qualifier. In a perfect world, you would want to borrow as much money as you possibly can on a property that you want to invest in, okay? And so in order to maximize your purchasing power, getting a longer loan term allows you to do that. Now, does that mean that you have to carry the loan or have the loan for that entire 30 years? No. You can pay it off early. You know, you can make extra payments, but at least the burden of your payment would be less, okay? And would allow you more flexibility in being able to, you know, pay it off as quickly or as slowly as you sort of choose to. Okay, does that make sense, everybody? Yes or no? On a very simple, fundamental basis.
Do you get like fees or anything if you try to pay off your mortgage early? Yeah.
And we're going to get into that in excruciating
right, but
detail.
they don't like, they make it hard, right? Like if they certainly make it hard.
Not today.
Gotcha.
Okay.
Moving on.
Yes, prepayment penalties, loan origination fees, servicing fees, all of that sort of stuff we're going to get into, and it's going to make your ears bleed.
Can you get a loan for a commercial property for 30 years? No, right?
You can, in certain instances, like HUD, as an example, has for some apartment communities, they will do some 30-year financing. Now, for standard, normal, like shopping centers, office buildings, industrial buildings, most of the time what they will do is some form of a 5-year balloon note, but then they may amortize it over like a 15 or 20-year sort of amortization schedule. And we'll talk about all of that as well later, not today. Because we're running out of time and I want to make sure we cover everything I want to get covered.
It's about
Okay. Okay. All right. So I think we're good to go there. Oh, there's one more little thing. All right. So let's just say, here's the thing to keep in mind about the calculator. You can constantly make just sort of add-ons like I'm doing here. Okay, we change that one variable, what's the outcome? We can change again and change maybe the interest rate and say, well, what if the interest rate were to go down to 2.5%? What would be the resulting payment? Now, this is still going to be predicated on a 30-year term because that was the most recent thing we put in. So in doing that, 2.5, and then solving for, so 47, 41, 45. So that would drop our payment down even a little bit more. So the simple lesson there, which again, we're going to get into this in so much detail, like I said, you're going to love it. is that it is absolutely mission critical that you really try to get the absolute best rate that you can possibly get on a mortgage loan, especially when you're dealing with large scale properties, because it can have a huge impact on not only the viability of the property, but also in terms of your overall rate of return. That if you're lazy and you just simply go to a lender and don't really put a lot of effort in trying to chase down the best deal, it will probably end up not giving you the rate of return that you really want. Okay, that's the final lesson on that. Now let's move over to other stuff before I lose time here. So what I'm going to do is I'm going to give you 30 minutes for the quiz. Okay. All right. So the other handout that you have in front of you are some sample problems. All right. So let's take a look at some of those sample problems and see if you can work a couple of those sort of on your own. All right. So, do number one on your own. The sample problem. I'm going to take up all the textures already. And on the second problem, work with your neighbor if you need to.
No, you should then.
Not going to do that on the quiz, but we can do it now.
Because then if you have anything set up as like 12 payments per year, it'll automatically put it.
The whole shift down. Whatever, you never just put down.
I have it.
Fair enough.
And if you finish with number one, go on to number two, so forth, so on.